Good afternoon to all. Let me again welcome you all to the second day of the Internal Refresher series. We have with us today the first expert speaker for today, CA Preeti Sadarangani. She joined us from London. She is currently with the Vodafone Group. Welcome, Preeti.
Thank you.
We also have with us CA Aarti Mahajan, and she is the second speaker. So I welcome Aarti as well. And we also will be joined by the whole panel and the panel moderator as we progress through the session. I also recognize presence of Vice Chairman of WRC, CA Vishal Doshi, Sachin Shah. He's been like the architect behind this program all throughout. So Sachin, thank you for all the efforts. Rishabh from the Internal Audit Committee, he's also helped us a lot. And Ruta Chitle, he's also an internal auditor. And we've done a lot of programs together in the Pune branch as well. So welcome all of you guys. Let me now request CA Vishal Bhai. Vishal Bhai, over to you for the opening remarks and also introduction of the first speaker.
Yeah. Good afternoon, friends. Thank you, Murtuza Bhai. I take this opportunity to welcome the speaker, CA Preeti Sadarangi, and all the coordinators, Sachin, Ruta, Rishabh. Friends, at the outset, I would like to compliment Murtuza Bhai for stitching together this series on internal audit and coming at the right time. In fact, if you look at it, the blend is also for the first time that we are having a 5-day series where on each of the day we are going to have presentations for half of the time and another half of panel discussion by expert panelists and the moderator. So that gives an excellent blend of the technical aspects with respect to internal audit, as well as a discussion or a platform where we can have a lot of sharing of knowledge and I would say the practical aspects by way of the panel discussions. In fact, if I look at the present situation that all of us are in worldwide, I would say, and especially today because our first speaker is from London, because of this pandemic, I believe the role of internal auditor has increased significantly. I would not undermine the position earlier, but I am just trying to say that it has improved significantly because now the need for the assurance from the internal auditor, to the board, to the company, to the statutory auditor, to the regulator has become more important. Let me share a very simple experience. I am part of on the opposite side of Murtuza Bhai. He is an internal auditor and I am a statutory auditor. And so it becomes I have closed so many financials of listed companies starting from June, and in almost all the cases, with respect to ITGC and all, we have done such a deep, thorough verification, documentation that it becomes, I would say, very, very relevant and pertinent from a documentation point, because tomorrow if the NAFRA comes and asks us about our audit file with respect to the internal controls and how you did the audit, working from home, or from a remote remote location, then it has these documents, these processes, the risk matrices, I would say, the testing of the controls and all, which would be a very, very important part of audit documentation, be it for a statutory auditor, be it for internal auditor, and definitely a lot of importance for the management when they are giving the director's responsibility statement in the board's report. So I believe that this, that is why I said that this series is at the right time, and we have, Murtuza Bhai has had a great panel of the speakers on all the 5 days, and we have definitely one of them, expert CA Preeti Sadarangi today with us, who is going to speak on developing a risk-based internal audit plan, a practical approach. It is my privilege to introduce her before this audience. She is the Global Head of Audit, Corporate and Commercial at Vodafone PLC. Preeti has over 20 years of experience in building and running risk, governance, and internal audit across multiple industries and geographies. In her current role at Vodafone PLC, she is responsible for leading global and diverse teams to deliver valuable and insightful thematic audits across the group. She also plays a key role in shaping the strategic relevance and enhancing the effectiveness of the global audit function with a focus on building and developing team capabilities and competencies. A champion of diversity and inclusion at the workplace and a coaching champion, Preeti is the proud winner of the 2019 Inspirational Leader Award by the Chartered Institute of Internal Auditors UK and Ireland. So with this background, Preeti ma'am, I once again welcome you on behalf of WRC. Thank you, and over to you. Murtuza bhai, back to you, sir.
Thank you. Thank you, Vishal. And
Thank you, Vishal bhai. Yes. Over to you, Preeti.
Thank you so much. And I completely resonate what was just said about how the relevance of this topic is today with COVID. Clearly, not too many of us would have anticipated that you would have a risk like COVID or a pandemic that would come around the corner. We could think about a lot of risks like, like technology changes, like artificial intelligence and things like that, which also a lot of companies and industries may not have predicted and are probably facing the repercussions of their continuity almost. But clearly, if an audit function will have to keep pace with that as well. So I'm going to start with really talking about the risk-based audit plan, and in the next probably 30-40 minutes want to cover certain topics. Clearly the need and benefits of a risk-based plan that we've just talked about. I want to talk about the components of the audit planning process and how that process will support a risk-based plan. And then I'll talk through each of these. This is a practical approach session, so I'm going to bring it to life in terms of how we do it. Will differ from company to company and even industry to industry, but hopefully will trigger some thinking in your minds in terms of, can we do this, or how relevant could that be? And then I will end with a little bit on also how we responded to COVID. So clearly, why do a risk-based audit plan? Probably not a question that is anymore to be answered, because most of you probably are already doing risk-based audit plans. And the question is, as long as we recognize why we are doing it. It was just said earlier in the introduction that we play a very key role as an audit function to the business, to management, to the board, to the shareholders, and to the stakeholders. And they're clearly looking at the audit function for assurance, for insights, for value, sometimes even confirmation of what they are doing. And it's very important that as the business evolves their strategy or their objectives, the audit function has to mirror that. And we can only do that by focusing on what they are focusing on. And that's very important for us to be relevant as well. Otherwise, we really run a risk of doing an audit plan like a machine that we are running, but it's not really adding value to the organization. Clearly, we are seeing dynamic environments, like I've talked about technology changes happening in various industries and how technology is disrupting the world of business, right? So today, I think there is so much that's happening in the digital world in most industries, particularly on the B2C world, where everyone is just picking up their phone, using apps, etc., compared to the good old days of either calling up somebody or doing a little more manual process. Clearly that world has changed, and therefore we've got to focus on the new risks that come out as a result of these changes. And then there's also the piece around we are at the end of the day a cost function. So we have obviously audit resources. They're skilled, they are talented, they understand the business, they understand the risk, but we've got to effectively use those resources to add that value to the organization. And obviously we will then be governed by the standards from professional bodies like the ICAI to also help us do that. So moving on, I think let me just talk about the components of a planning process and how that can really support creating a risk-based audit plan. And I will talk about each of these in detail. So the first starting point for me is the audit universe. We need to know what do we audit, and what is the auditable universe in the organization. The next is really risk dimensions and risk inputs. So saying what's the lens of risk that is relevant to your industry, to your organization, and therefore, how would you look at that to your company? We then have planning principles. Now I say this because it all depends on the complexity, size, again, nature of the industry. If you have a very large, complex, multinational, multi-state organization, then you might need to some planning principles that would help creation of the plan. If not, then clearly that's really an optional stage, and I'll share with you how we use that. Then you create a risk assessment. Based on that, you do a risk-based audit plan, and last and definitely not the least, continuous risk scanning, because you got to, like I said, the world is changing and constantly changing, so you got to continuously scan what's happening in the environment outside. So the first component is the audit universe. Now this again, I can't stress enough on how important this is as a first step. And the definition of an audit universe is really the auditable universe that you can subject to your assurance activity. This is a catalog, it's a list, it could be simple, it could be complex, again depending upon your organization and the industry. It's basically a catalog of all processes which are running in the company. It also could include a list of all your entities and locations, and the list of service lines and product lines and the business lines that you operate in. So we've given a little bit of a snapshot here in how Vodafone does it at the PLC level. So we have the audit universe at 3 levels. So we have an L at a level 1, level 2, and a level 3. The level 1 are the processes that you can see on the screen, which is basically on cyber, legal, regulatory, financial management, people management, supply chain. That's your L1. That's really the main process or a function of sort. You then break that down further into a level 2, which could then give you a lot more detail. So we've given an example on the screen. For example, if you're doing a sell process, there are multiple sub processes under that. And I'm talking telecom because I come from a telecom industry. Your sub processes that you may want to audit starts with your sales opportunities. It's after that you move to your customer acceptance process. Then you have your customer registration contracts and conditions. Then you have your sales commissions, etc. Now this point is important because one could, and I can give you another example of people management, or what we call as HR. So it could start with, we'll have on onboarding or recruitment and resourcing. It could even start with your organization design. So is the organization fit for purpose for the operating model that your company operates in? You then have payroll. You would have learning and development, reward and recognition, performance and talent management, health and safety, contractor staff management, because obviously there might be organizations, including us, we use a lot of contractors, etc. So this is the whole piece that is important. To starting point is to have an audit universe. Again, I keep repeating, it may not be as complex to the L3 level. You need to do it fit for purpose for your organization, but this is the starting point. The second piece is on entities and locations, right? So if you're a manufacturing company, you have your factories, you have your warehouses, you would have your offices, you would have your your own franchisee or owned retail places, etc. So you need to look at your universe of all entities in all geographies and all locations. That is part of your universe, and therefore becomes something to consider when you're creating a risk-based audit plan. And lastly, it is service lines and products. Again, in the case of Vodafone, you will have prepaid, you will have postpaid, you will have the Internet of Things, you will have consumer, you would have business to business business lines, you have the M-Pesa, which is the mobile money, you have cloud services and cloud products. So you could have multiple service lines, multiple products, and multiple business lines. And all these three elements you need to look at as a starting point, that this is your landscape of the universe. Now, what can I do in this as a risk-based audit plan? The next stage in, or the component for me, is really the risk dimensions and the risk inputs. So again, quite important here to say, what are the lenses of risks that you want to look at? And there could be multiple. I'm just giving you some examples of how we would look at it. Many companies have a whole list of company policies. So that's a risk dimension itself, because some of them, so you could have hundreds of probably policies in the company, but not all of them are of the same level of risk or importance. So you would need to look at that lens of saying, is there a lens of high risk policies that you want to consider? Processes, so that's a risk dimension again. And we've just spoken about the audit universe listing out the processes that you need. Similarly, the geographies, that's a dimension that you need to consider when you're creating a risk-based plan. Now, every company in some shape and form will have an enterprise risk management process. So there are company principal risks that you would deal with. That is another input, because at the end of the day, if it's a risk-based plan, you want to let the management and the board be aware of as what percentage of the principal risks is your audit plan covering. And business lines, like we've spoken about, so product lines, service lines, or business lines. Now, various sources of risks that you can have to help you make that plan, right? And the sources could be both internal and external. So what could be the external sources? So you could have media industry reports about your company, about your organization, about your industry. What's plaguing, or what's the challenge in the industry that's going to happen in the next 2 years? You could have if you're operating in multiple countries, then a country corruption index sometimes helps in identifying for particular topics, is that a topic of interest for that country? There would be lots of risk and advisory firms and consulting firms coming out with their thought papers or their positions on what the risks in focus are. Now, these are all external inputs that are really helpful. So to give an example, I know in the FY 2021, which is the current fiscal year, when we looked at the thought papers from globally, from the big four, from the others, Gartner, IIA, and the big four, a lot of them will talk about cyber risks, will talk about privacy risks, will talk about regulatory risks, will talk about culture, etc. You will find a pattern in a lot of these inputs that come through. Obviously, you will have to convert that into how is that relevant to your industry and to your organization. You then have obviously economic and political environments that you also would want to know. So, what's going on there? What's the regulator thinking? Are they expecting some regulation changes that could impact your industry, etc.? And again, last but not the least on external sources is the independent auditor's opinion. So in Vodafone, I personally have a quarterly catch up with the partner of the statutory auditor, exchanging notes in saying what are they seeing and what are we seeing. So there's a constant engagement between us to add value to each other in saying where do they see risks and concerns and where are we seeing concerns as well. So that input helps us to also forge what your audit plan eventually will look like. And then, of course, there are lots of internal sources. And I think, again, all of you do a lot of these. So management interviews at your location, market, group, what's the management perception of risk that comes in as an input to you. You will look at audit results of the past 2 years, 3 years, and where are the areas that you've actually had unsatisfactory audit results, or even in which territories do you have unsatisfactory audit results, and therefore is that something that you would want to consider and input into your plan. Many organizations have a very formal second line of defense, like a compliance function or a risk functions. Some of them don't. It depends to company to company. But any assurance result from there is helpful as well, because then you get a sense of what are they finding. And also the other input is, for me, you don't want to duplicate the same work that they've done. So how much of it can you rely from them, and how much of it that actually inputs into your plan? For me, the next one, which is outsourcing processes, is quite a key one. Lots of outsourcing happening. Therefore, if you're finding some processes which are embedded into outsourcing where the operations are outsourced or offshored, important to consider that, because how does the organization and management get assurance that that part of your operations which is offshored is actually being managed in the level of control environment or governance that you would want to set out for yourselves. And then, of course, there's operational and statistics and the KPIs. And to give you an example or to bring that to life, like I said, I'm from telecom. We have in various markets, postpaid, prepaid, consumer, enterprise, and all the combinations of product lines. If I have a market like Mozambique, for example, I know that that's a prepaid market. But when I look at my operational statistics, I will not necessarily consider doing a postpaid audit there, because that is a very, very small amount, but my major risk is in a prepaid. So that kind of an operational statistic in terms of what your revenues are by market or by product line, what the revenues are, what the profits are, and any other relevant KPIs for the industry helps as a data input to decide what kind of a risk landscape that you have. And again here, last but not the least, there are many companies and many industries going through their own change of transformation programs. And that is something that you need to input. So in case, for example, there's a digital transformation journey that's happening in your organization, then that has to be factored into either at a program level of an assurance level in saying, is that program going fine? Or if digital is embedded in your operational processes, and that's a relatively new thing, then you would want to cover those areas, because the organization was used to doing it in a different manner. Now the thing has changed, so how do you give assurance as well? And digital clearly creates new risks, whether it is cyber, whether it's fraud, whether it is denial of service, whether it is downtime, customer experience, etc. So if you put all these sources of risks and inputs together along with your risk dimensions, that kind of becomes a bit of your starting point then to the risk assessment process itself. Moving on, I mentioned planning principles. Again, like I said, this depends on the complexity and size and the nature of your industry. We have a planning principle because, just again for the benefit of all of us, so Vodafone PLC operates in multiple countries in Europe and in the African continent. And because we have it so distributed, so large and so diverse, we believe that we need some fundamental principles that will guide the audit planning process. So for example, we said there has to be some percentage balance between the local risks and the global PLC risks. And we split that into as a number 70-30 or a 60-40, which says 60% of the audit plan will be global thematic audits, which will be done in multiple countries. To give an example, we could select, say, a cyber audit or a privacy audit, and we would then have that audit delivered in the same time in 10 to 15 countries, so that we can give an opinion to the board at a PLC level that this is how privacy is being managed at global PLC, right? But the local risk can't be denied as well. So again, to give the example of a Mozambique or different from, say, a Greece, there could be a very local risk that they are facing at that point in time. So we have about 30% to 40% of the audit plan focused on the very localized operational and risks as well. The other principle we use is to have a bit of a rotational approach on the high risk policies and processes. So we have about 10-12 high risk policies in the company. So anti-bribery corruption, economic sanctions, privacy, cyber, network resilience, business continuity, etc. Because these are high risk, we want to ensure, even if it's positive assurance, that we cover that in a cyclical approach. So we ensure that every high risk policy gets covered every 3 years, so that there is a continuous lens on how that is being performed, and it doesn't slip really from the radar, given the fact that it is classified as high risk. Coverage on principal risks I've spoken about. Clearly that is a principle, and we say that if these are not strategic risks, so from a principal risk point of view, you could have certain strategic risks that an internal audit function may not be able to cover. And that's fine as long as that is explained to the board and to the management in saying the audit plan covers X percentage of the principal risks. The Y% that is not being covered is primarily because these are strategic risks and there is a management oversight process that is following, and there is enough transparency with the board, and therefore internal audit need not or may not cover those areas as well. The other planning principle I mentioned briefly is alignment with the second line, which is the compliance function or the risk function, primarily to avoid duplication and audit fatigue. And this we've learned really the hard way. We would have the compliance team go and perform an audit on anti-bribery. Maybe a couple of months later, the audit team would go maybe to the same markets. And the markets would say, why are we being audited twice? Why can't you just coordinate a little better? And probably that's another subject, which would probably take another session on how integrated assurance work or how aligned assurance works between the second and the third lines, because both of us intend eventually to give assurance to the board. Again, planning principle being that we need to include all the markets and geographies based on the size and the risks of the market. And if you're excluding any market, territory, or geography, then there has to be just good reason to do that, which is again risk-based. And finally, the focus has to be on established, emerging, and evolving risks. Now, what I really mean by that is you could have an established risk in the sense that financial reporting as a process is clearly there. It is an established process, but then there is always that nagging concern, maybe once in a couple of years, in saying, okay, we need to relook at, say, revenue recognition or anything else. But if I take that same example and say that a couple of years ago, when IFRS 15 happened, then that's now beginning to emerge as a different risk, to say, therefore, can we cover that same process again, because now that's an emerging risk. To a future state, again within Vodafone, we're now moving from SAP that we used to use to SAP HANA. So that's going to be an evolving risk in the future, in saying we need to keep an eye on that, because as that progresses, we need to look at it. So it's helpful to get a good balance across established, emerging, and evolving risks. Classical other evolving risk could be an acquisition. So if there's an acquisition by the company, then there will be an integration process. Therefore, there is a bit of an evolving risk of saying, would that integration work? Would the level of control environment remain the same, etc. Digital transformation is probably the other element that you would want to look at. So you need to balance the kind of risks. So these are some of the principles we use just to inform the audit plan. So now you have a universe, you have all the dimensions, you have all the inputs, and you have some principles. We then start on the risk assessment itself. We start off a little bit first by the process, but let me just run you through it. 3 stages really. The perception of risk. So how do you process all the inputs, internal and external, into a sensible perception of risk? How do you then take care of the coverage? And then therefore, what will eventually come onto your plan? So from a perception of risk, we still use good old Excel file. So we have our our process universe listed out. We then map, does that relate to a high risk policy? Yes or no? Is there a regulatory requirement that drives that process? Did we have not good or poor audit results in the last 2 years? What's the degree of change and transformation that's happening as a strategic initiative within the company on that process? Do we have key performance indicators which are below the target? Do we have even below par second line of defense compliance results of assurance activity? And is there an area of strategic focus of the company? So we answer a bunch of these questions in a yes, no, which is very simple. Like I said, the risk assessment process can range from being a very complex AI-driven risk model, or it can actually be a very simple fit for purpose to your organization, as long as you've used professional judgment to ensure that you have addressed the right risks in the company. So we answer these questions as a simple yes or no. We then use a bit of a simplified mathematics of saying wherever we have answered for more than 2 such parameters as yes, primarily we are saying the perception of risk is high, right? And similarly, we then go to a medium and a low. We then ask for the coverage. Has that process been covered in the last 2 years, or at least in the last 3 years once, or has not been performed at all in the last 3 years? And again, if it has not been performed in the last 3 years, we are saying that the perception of risk from a coverage point of view becomes high. But if you're covering that every year, or in particular in the last 2 years, then really that risk kind of drops because we have done it time and again. And then we put these two components together to then decide whether that should be in the risk plan, in the risk-based audit plan or not. So you can see that little table that we've created. Now, just to let you know, any form of risk assessment is not going to give you a list of audits to be done in the year. There will always be professional judgment to be used, and that has to be used by all of us because we are trained, as an audit function. But this gives us a bit of a direction to how do we narrow down the universe into what we want to focus on. So if your perception of risk is high and we have not done the audit in the last 3 years, then we need to bring that into the audit plan as a combination. If we have the risk of perception is high, but we have done this at least once in the last 3 years, it goes into a bucket which says basically, we want to consider this. We probably need to use another professional judgment lens in saying what can trigger the need to do this audit in the plan itself. So you could then layer that into saying these clearly are meant to be on the plan, but for the rest of them, we need to reconsider. And then there is a discussion and a conversation to saying, why do we need to consider? Is that relevant? Again, going back to the need for the audit plan, you only have that much effort and resources and time to deliver the plan. You have the strategic input of the company. What do you want to focus on? Right? Moving on, so that's the process part. So now you know probably what are the areas you want to cover in the audit plan from a process point of view. Then the next question is, what are your entities you want to cover, right? And the decision on which entities or geographies you will cover will be based on some, again, internal and external inputs. So you would look at size, so revenue, profits, EBITDA, customers, employees, assets, depending upon the process you cover or depending upon the nature of the business and industry you have. Look at the performance by market or the geography. Typically, when you have a market that is not performing too well in terms of profitability or revenue, you know there are pressures in the business. You know then there is a likelihood of management getting creative to do what they need to do to bring up the performance, right? And therefore that could be well an input in saying, do you want to focus on some of them because they're going through a longer challenge, for example. Corruption index I've talked about, the political economic stability, regulatory changes, mergers and acquisitions, or even restructuring. I can give an example on the last two, for example. So we had in the last year, clearly the Europe as a continent went through its own economic challenges, in terms of the economy. Now we had certain big markets where also, like Italy, we had new incumbents coming into the telecom sector, right? And they came in really cheap with very, very low pricing. Clearly Vodafone Italy then started feeling the pressure of performance, and obviously they did what they had to do. They were trying to do what they needed to do to counter the competition in the market. One of the things they did as a solution to that was to restructure the operating model within the company, which also led to not just reorganization the functions, but also to some redundancies. And the management requested us to come in and say, can you help us identify or give us an assurance that the restructuring program is fit for purpose and will achieve the objectives? And our lens was also from saying that, so you have a business case of why you're doing the restructuring, but it's also important that when you start restructuring and creating different kind of process and operating models, the natural lens is not on the control environment. because the objective of restructuring is to manage the business competition. And when we came in, we actually provided them assurance or lack of assurance, if I may say, on saying that it was not necessarily keeping the lens of the control environment. So when you're restructuring processes or design of organization, you got to keep in mind how the control environment would also react and keep in pace as well. Similarly, regulatory changes. Telecom is probably the most regulated industry, and we obviously keep having various regulations coming through across countries, different regulations at different point in time, with sometimes even very little time to respond or react to that regulatory change, and with a go live date. So then there is this whole piece on saying we are expecting a regulatory change. Do we need to do something in that entity or market upfront so that there is a state of readiness to respond to that regulatory change? So now again a bit of a recap. So we have the universe, we've done the inputs, we've got the risk assessment done, and now all that will go into this machine and create an audit plan. So clearly it's important that the plan does cover the universe. Logically, it covers all business lines as well as all the entities that your industry would cover. And again, when you're looking at products, it's important to look at that product line, how much it contributes to revenue, what's the rate of year-on-year growth, and what are the number of customers that are on it or will be coming in because of your year-on-year growth. So some product lines and business lines look small, but if you look at year-on-year growth, they're probably growing at 30, 40, 50, 60% growth year-on-year. It's important then to consider that in your mix of audits, because you need to be sure with the management and give assurance to management and the board that that process to deal with that product line is sustainable given the growth rate that you're going through. So what you see on the left hand side as a snapshot is just how we map our audit plan to the level 1 of the audit universe. So we have the strategy, governance, commercial, technology, finance, and legal and regulatory, and our plan is mapped, and the percentage of plan is provided with an indication of change from the last year. Now, if there is a significant change, then we normally give a narrative and an explanation as to why there's a change or why it has increased. So you would clearly see technology will increase because the cybersecurity risks are increasing. And given that we are in a technology company in telecom, there's a lot of stuff that's focused on the network and the IT infrastructure. We then also have the audit plan mapped to the company principal risk as well. Like I mentioned earlier, these are your principal risks that are published in your annual report. And if we are meant to do a risk-based plan, we need to let the board know what percentage of risks we are covering and not covering, and why. And I think the key piece here is really transparency to the audit committee and with the management. Again, and I will cover that a little later, probably immediately in the next slide, is how we need to keep a track on the company risks as well. So if the company risk changes or the mix of the risks change, then we've got to mirror that. And again, like every other company has gone through, so has Vodafone. We had a enterprise risk process in sometime in Jan, Feb of this year. We went into the audit committee in March saying these are the principal risks of the company. And then obviously by then COVID had hit the world. We were going into a lockdown, etc., etc. So quickly and speedily enough, the enterprise risk team then had to relook at their principal risks and the risk register to saying what are the threats in the external world that the COVID will create, what's the impact of that on the company, and therefore what my principal risk changes. The moment that changes, that's then an input back to the audit function to say if the risk lens has changed in the company, then I can't be doing audits which are business as usual. I need to respond to that in a manner that will then give the board comfort in saying, okay, we are managing our risks. given that these are such new risks that are happening now. Again, I've spoken about this a little bit from a principal point of view, that we have a rotational approach on the high risk policy. So this is just a snapshot of how we do it. Is that we will again map the audit plan to the risk view, to the policy view, and then do a 3-year rotation approach as a principle, but we will calibrate it with the perception of risk. So you would see, for example, every year we're doing an anti-money laundering because we have M-Pesa as a mobile money product in our African markets, which we consider as high risk in any case. Technology security is a no-brainer, cyber is a big thing, and clearly, given the number of assets that we have in a technology company, that risk in some shape and form, and the scopes could differ from year to year, but they all add up to the policy of technology security. And similarly, to give an example of sanctions, we would do that on a rotational approach, but we will do that from a continent by continent, because that just helps us give an opinion differently to the board. So I think just as a summary from a plan point of view, when you make the plan, it's obviously important that it gets mapped to the processes of the company, to the principal risks of the company, to the policies of the company, to your entities and geographies in your organization, and to the product lines and the business lines. When you look at that as a map, there's almost an assurance map or an audit map that gives comfort to the board and management in saying, okay, this is good coverage, and there is a logic to why this is the coverage that it is. And last and not the least, is really the continuous risk scanning. And I can't even, and I'm sure all of you now know how this cannot be missed at all as a step. In the past, obviously the continuous risk scanning in many companies, or even in ours for a point in time, used to be done in, you have an audit plan which is annual, you then do a mid-year and audit plan review again to saying, are we still fit for purpose, and we do that. That's also fine, and that's perfectly workable given the scenario or the company or the complexity. But more and more, again, thanks to COVID and the pandemic and the surprise element that came with that, clearly we are saying that that may not be sufficient. And therefore, it's almost a continuous risk scanning and continuously looking at internally and externally to say what's going on, and therefore is my audit plan relevant yet to the company. So again, internal events I've talked about, whether it's mergers and acquisitions, you could have a security incident or an event, you could have a cyber attack, you could have a privacy breach, you could have any such element that you would need to respond to. External events, COVID is your biggest external event that has happened, but you could have a regulatory change, right? So a lot of those external events that need to get triggered. Some of the external events that we track is litigation or cases that have been filed to our competition or to other telecom companies, because we say that if that can happen to that company, can we then also look at our process to say, are we compliant or are we not compliant? Because clearly the regulator is then becoming more and more vigilant and a lot more even aggressive at times. Management requests, clearly they are the closest to the business. So they would obviously have either there's a transformation happening, a change happening, or they are concerned, they are the insiders. So they would come to us and to all of you in saying, can you cover this area of audit, because we consider there's a concern there. What we are now beginning to do, and I know agile audit planning is probably the buzzword that a lot of us hear about. I'm not so sure that I know what an agile audit planning process looks like. But if I was to just put that in our context, we are planning to bring in almost again, as part of the continuous risk scanning, have potential themes based on all these inputs, like a wallpaper available to our audit leadership team. And we then say that there is a potential theme that's on our wallpaper at every point in time. We need to keep looking at this wallpaper to say, has anything changed? Therefore, do we need to adjust our audit plan, right? And then we have a bit of a rolling audit plan, like the business has a rolling forecast or a rolling budget. We could then build, so we still have an annual plan, but then we get transparent to the board and management in saying, we think this is the plan, but it is likely that 3 months or 4 months or 6 months from now, there would be a change because there is a risk scanning that's happened and that has changed the context really to the risk that we are looking at. So clearly this, I cannot more stress on the importance of continuous risk scanning to make ourselves and keep ourselves relevant to the organization. And lastly, I just thought I'll share a bit of a snapshot on how we approached the global pandemic. So like I said, clearly there was a change on the enterprise risk level. We then debated amongst ourselves on what would be the threats or the operational level risks within the business. And then map that to saying which process or business or product line will it really impact. So to give an example, one of the scenarios or the threats we said, clearly as a result of the pandemic, there will be financial difficulties by the customers because there would be lockdowns, there would be businesses putting, going on hold for a bit. In the UK, a lot of employees were being furloughed, which is basically already being considered as being made redundant, etc. So clearly we realize that there is going to be an economic impact. How does that affect us as a company? Clearly we know that our bill collection process is going to take a beating, right? Because if there's financial difficulty, you don't want to hound your customer or disconnect your customer because there's already a pandemic going on. They're already facing difficulties. You don't want to put further pressure by not by disconnecting their accounts, etc. So the collection process will evolve. The collection process will also or could probably lead to higher provision for doubtful debts because you don't know how that would go. All the bad debt model and estimation models will completely have to undergo a change because this is not a common scenario. This is not a business as usual scenario. Because the collection process could get impacted, our liquidity and working capital as a company could get impacted. We also said that the new sales process could get impacted because if you don't have more customers buying because of the pandemic and because of the uncertainty the pandemic has created, clearly your new acquisitions will get impacted. We then mapped that to which process that we would want to cover in the audit plan. So clearly the credit rating and the collection process, treasury and working capital management, and also the new tariff and discounts, because we started giving a lot more new tariffs and discounts, and we wanted to ensure a couple of things. One, are we giving it to all eligible customers so that there's no customer that is deprived of that benefit? Is that also being configured correctly in the billing system and the CRM system so that what you're promising is what you're delivering? And finally, which is also very important, is whenever we come out of the pandemic, and hopefully we shall come out of that soon, these new tariffs and discounts eventually will also have to get phased out, because clearly these measures are ad hoc measures to respond to a particular situation, clearly has an impact to our revenue and profits as well. So therefore there's a reason it has come in. It cannot be forever, right? Similarly, you could have financial difficulties by vendors, their ability to supply equipment, so spares, or even they have logistic challenges. And therefore, we will look at the process on how have they responded by sourcing and onboarding. How are they developing new vendors as a vendor mix? Clearly, a lot of us working from home, clearly increased phishing attacks. As in, I think I get at least 3 emails every day on my official email ID from completely unknown spam kind of emails saying, this is something's happening, and if you need more information, click on the link, right? And I know for a fact that in our own company, a lot of people have clicked on those links. Those links are obviously malified links, and then you'll end up exposing the company to a whole lot of phishing attack or a cyber attack. So we have obviously on our audit plan the data loss prevention and phishing attacks audit. We will do the cybersecurity audit and again privacy control, because you don't want loss of customer data at this sensitive time. And the last one, again, as a threat or a scenario we saw, so it was an opportunity but clearly could create a threat, is we saw multi-fold increase in voice and data consumption. Clearly that puts a pressure on your networks. and therefore the impact is on network resilience, and there would be enough that we will invest in to create capacity for that. But because the volume is so high, and because it's happening under such pressured environment, and it's happening remotely because we're all working from home, clearly the network change management as a process was important for us to look at, and then see, you know, how the change management is happening, and therefore how robust it is to ensure that the controls are still working. So this is, I just thought I'll share this with you in saying, and like I said, I know a lot of companies and all of you have already gone through this in your organization. Just wanted to share, this is how practically we approached the global pandemic and how we updated the area of focus. So if I was really to summarize, like I said, it's important that all the stages get through. You have to start with an audit universe. You will have to consider all the inputs, whether external or internal. Then obviously have some form of a risk assessment. Look at your plan, use your professional judgment, see what's relevant to the business, what's relevant to the strategy of the organization, what's relevant to all the other threats that you have looked at. Have the plan. The measure of knowing whether your plan is fit for purpose is mapping it to processes or to policies or to enterprise risks or to product lines, to just get a sense of landscape of coverage of your risk-based plan. And again, last but not the least, continuous risk scanning all the time. It's like your antenna has to all the time be on as to what is the next thing that's going to happen or is going to be a threat to my company. I'm going to pause here. I know I've kind of gone through quite quickly and a lot has been said, but I'm going to pause just so that people have time to reflect or have any questions, and I'm happy to take them.
Thank you, Preeti. So quite well covered in detail, and there are lots and lots of questions. So I have picked up 3. In the meanwhile, Sachin Shah, if you can also, Preeti will take at least a few, 4 or 5, if you permit.
Fine.
Okay. So your view of agile IA plan, how frequently you are revisiting the plan considering COVID-19 and related development? I think you covered, but still, if you want to add something to that.
Yes, absolutely. So I think COVID has been a bit of a wake-up call for a lot of us, right? And it's actually brought to the fore that changes in the risk environment need not be predictable, right? So we can always predict a change in strategy or a change in technology, but how do you predict a pandemic? And today it's a pandemic, tomorrow it could be something else. So that's the new normal. So for me, it's a continuous one, which is why we are looking at a rolling forecast of an audit plan, which is what I mentioned, to have that like a bit of a wallpaper and say, these are the areas we want to cover. Therefore, how do we keep bringing that back onto the table once in a while to say, okay, this is now becoming real. Therefore, we need to recalibrate the plan, drop off something which we could move to the next year, or or even drop off for the moment. So yeah, it'll really be continuous now. I don't see it periodic in that sense.
So I think one more question which was there: should audit plan include strategy related audits? To what extent organization is prepared to cope with technology disruption and competition? And it also goes on to say that did audit heads of telecom companies in India predict about the risk which Jio will cause or the disruption Jio will cause?
Okay. I'm representing Vodafone PLC, so I'm not sure that I'm even even the local audit plan of the India entity is visible to me. So difficult for me to predict that. But let me answer the question on the strategic risk, because I think somewhere the answer would still come through. If the strategic risk is disruption because of competition, right? Clearly there is assumably a lot of focus at the board level and at the management and the execo level on how the organization is responding to the strategic risk. Frankly, as auditors, beyond a point, we can't tell the management that this is how you respond to the strategic risk, because management knows the business much better than us. Where we can help is try to understand which are the processes in the organization that can help you to cope or help the management to cope with that competition risk. So to give an example, If there's a competition risk, then we will probably look at how they are managing the performance management of markets or of product lines, right? We would also look at how they are managing tariff management in the company, in the markets, to see how are they responding to that, and are they responding to the competition through tariff plans by, yes, meeting the competition levels, but having a business case which is probably negative to you in the long run. And we would then look at that process to say, it's fine if it's a tactical suggestion, but then we are also saying that, are you doing a I'm going to say post implementation review, but really a benefit analysis at the end of your new tariff to say that have you coped with that risk. The other strategic risk is typically your digital transformation you spoke about. We do in audits in Vodafone PLC a lot of audits around program assurance. So if there is a digital transformation agenda of, for example, many years ago, to do a lot more of transactional facilities on the Vodafone app, then we would look at the program assurance around how they have thought of implementing the Vodafone app, right? We would then also look at, I know a lot of legacy systems, billing systems in a lot of our markets are being transformed into new age billing systems. We would then look at that program assurance in saying, is that program being managed well to meet the strategic objectives? So in that indirect sense, you would still cover it, but not directly.
Thank you. So Sachin, maybe one or two questions.
Yeah, sure. So we have one question on the risk aggregation exercise. So the question goes is, do we have to restrict to, let's say, 100 or 200 risk within the universe, and try to understand, what can go wrong at each of the process level, and then aggregate to top 10, top 20, or top 30 risk? So what is the right strategy for risk aggregation?
Yes, so that could vary again, depends. So there are two elements there, right? So one is a process or an audit universe, and then you have your risk library. It is helpful to have these mapped, because then you know which process is mapped to which risk library, and that mapping is obviously very useful as a starting point. The approach could be varied. Like I said, we've used a logic of those criteria of saying, is there a regulatory impact? Is there transformation that's happened? Is a strategic focus, etc., etc. So if you have certain criteria on doing a high, medium, low, then it helps then for you to narrow down this whole combination of process and risk library into a more manageable number. But at the end of the day, you still, if I would call it the North Star. So the North Star is still your principal risks. Your North Star is still your high risk policies. So what is relevant to the company in terms of their risk, which is principal risks or high risk policies, or what is relevant to their strategic focus, those are the elements that you would definitely want to cover, and will bring that like a funnel, narrow it down to the space that you would want to then filter from. The numbers I can't comment on. It again depends upon the size of the company, the complexity of the business, how many markets, how many countries, or how many places they operate in. So for example, I can tell you in Vodafone at a PLC level, we have about 7 or 10 level 1 in the process universe. We have about 80 to 90 L2s, and we have about 180 plus L3s. But we don't analyze our risk plan based on an L3. We would normally do this on an L2, and sometimes even a little bit on the L3, but it's mostly on the L2, which is then mapped to the risk library then of the company.
Thank you, Preeti. Sachin,
Thank you.
So do we have,
I think in the interest of
okay.
Yeah. So Preeti, thank you very much. And Rishabh, I would request you to come over. I request Rishabh Jain to carry out a much needed vote of thanks. Rishabh.
Yeah. Thank you, Murtuza bhai.
Well,
I, on behalf of the WRC of ICI, and all the learned participants of today's session here together. And on my own behalf, extend a very hearty note of thanks to CA Preeti Sardangani and for gracing today's session and offering her valuable insights and practical insights on one of the most crucial elements of an internal audit, which is developing a risk-based internal audit plan. What is especially thankful is how she's given us a bird's eye view of how she's carried it out during COVID and even before that into her telecom sector as well. Again, on behalf of everyone present, I would like to thank you a lot, CA Preeti Sardarangan. Thank you so much.
Thank you so much. Thank you for the opportunity. Been absolutely a pleasure. Like I said, associated with the ICAI. So absolutely a pleasure. Thank you so much.
Thank you very much, Preeti. So we'll then move on to the second session for today. And I request CA Aarti Mahajan to join us. Aarti, welcome.
Yes, now I think you can hear me. Thank you so much, Murtaza. Yes, let's go ahead.
Yeah. So Rishabh, I request you to please introduce Aarti. Over to you, Rishabh.
Yeah, thank you. Thank you. Dear participants, it is my pleasure to introduce to you CA Aarti Mahajan. CA Aarti Mahajan is a chartered accountant with 15 years of experience in audit, risk, compliance, controls, and operations. She has worked with consulting firms and MNC banks for a significant part of her career, and presently she manages risks for Nayara Energy, a Rosneft company. Nayara is a $13 billion company which owns the world's most complex oil resources, oil refineries based out of Jamnagar. A Virgo to the core, she believes in the motto, work hard and party harder. And probably she is one of the very few people who has managed 2 holidays in the times of COVID-19 with social distancing, of course. She has 2 kids aged 18 and 14, and she's based out of Mumbai. Aarti, we look forward to your knowledgeable insights on integration of ERM with internal audit. Over to you, Aarti. Thank you so much.
Thank you so much, Rishabh and Murtaza. So let me just get straight to the presentation. I think you've given enough of an introduction for me. So can you see my screen now? Should I start? Is that fine and well?
Yes.
Visible? Yeah. Okay. Great. So hi everyone.
Yes, we can. Yeah.
Okay, great. So hello everyone. What Murtaza and the team has asked me today to do is run you through on how best to integrate 2 critical support functions for an organization, which is risk management and internal audit. Over a period of last day and a half, I think you would have gone through various sessions with several noted speakers giving you insights into what is it that these functions do for an organization. What is it that makes them important for an organization? How is it that these functions are reinventing themselves in the times of COVID? What I will do in the next 15-20 minutes is quickly run you through how is it that these 2 functions are complementary to each other, and what is it that they should do to coexist beautifully in an organization. So I thought, let me start with first giving you some thoughts on do organizations really choose to have both of these functions out of choice, or is it that there's a mandatory regulatory or governing requirement around having both a risk management and an internal audit function in an organization? So let's start with risk management. So if you'll see this, essentially Companies Act, SEBI listing requirements, as well as a lot of our corporate governance and the entire COSO body mandates that a company should have a robust risk management function in an organization. Now, why do they say that you should have a robust risk management function? What is it that they're expecting out of this risk management function? So the Companies Act has very clearly laid down sections whereby they're putting a lot of onus and responsibility on our governing bodies, the board and the audit committee, to comment on various aspects of risk management effectiveness. They have mandated that the board and the audit committee should have a process of identifying to make sure have a process which makes sure that all significant risks of an organization that threaten its existence are identified and are effectively managed. In fact, it has gone to the extent of even mandating that the independent directors should also bring their own judgment on the board's deliberation on risk matters. So what I'm trying to drive at is that the Companies Act, through various sections, has mandated the board and the audit committee and the independent directors to comment on the effectiveness of risk management in an organization. Now, if you look at COSO, what does COSO say? So those of you who are familiar with COSO would know that COSO brought out a recent, not so recent, back in 2017, a new framework, which clearly mandates that integrating risk management with performance and strategy in an organization. So the framework highlights the importance of considering risk for both strategy setting as well as for measuring performance of key personnel in an organization. So if we look at the COSO requirement now, essentially what is it saying? It's saying that when an organization is setting its strategy or it is measuring performance of its senior management, it is very essential that risk is given its risk mitigation, risk management, risk responses are given their due acknowledgement. Okay. Moving ahead, SEBI, again, the listing requirements very clearly lay down that the board and the audit committee have to review the risk management systems, comment on their integrity, comment on the procedures, risk management procedures for ensuring that the risks are minimized. So all in all, between these three governing regulatory bodies and recommendatory bodies, it's very clear that risk management is a very essential function which an organization has to have. Okay, now if we look at internal audit, there again, I mean, this is a statute all of you would be familiar with. Section 138 clearly says that an organization has to appoint a chief internal auditor, and it has to on a regular basis carry out various checks to ensure that the company is not deviating from the laid out policies and processes, whether set up by a regulatory or a governing body or its internal controls and processes. So basically what we're trying to drive at is that both of these functions are very critical for an organization, and hence we cannot look at them as a burden, but rather as a necessity for the healthy growth of the organization. Now, coming to the topics that I'm supposed to speak on, we're talking about integrating the two. Now, when we're integrating the two, what are we trying to do? Are we trying to pick up risk management, internal audit, and turn them into one department? No, that's not what we're trying to do. Are we trying to, so both of these are doing their own set of tasks. So are we picking up the two of them, giving them the same set of tasks to do? No, that's not something we're trying to do again. So what is it that we're trying to achieve out of this? What we are trying to do is that synergize the two effectively, so that ultimately we achieve an output which is more effective than both of these functions working in a silo, not talking to each other. Okay. So in the next few slides, I will run you through the semantics of how to work out this integration, and how is it that each of the department can help the other work more effectively towards the common goal. Okay. So when I say towards the common goal, one has to understand that whether it is the first, second, or third line of defense, at the end of the day, everybody in the organization is working towards the common goal of making sure that the organization strategy and objectives are met, right? So whether it is internal audit or it is risk management, both of them basically are trying to achieve, sorry, let me just remove this. Okay, so both of them ultimately are working towards achieving the same set of objectives. They're basically trying to do different set of tasks which are assigned to them, So if you look at internal audit, what it is doing is that giving the management an independent assurance on the adequacy of its risk management governance and control procedures. And what risk management is doing in turn is that it's making sure that the management, when conducting itself, is taking risk-informed decisions which are aligned to its strategy to make sure that the organizational objectives are met. So what I'm driving at is that ultimately both internal audit and risk management have a common objective of meeting the organizational goals. So since they have objective synergy, it is best that we have an integrated, we integrate the audit plan with the management's efforts to control risk, so that both of them are together helping each other meet this objective of ensuring that the management is doing the right things, so that its objectives are not compromised at any point in time. Okay, so essentially, what does it mean? It essentially means that risk will provide IA with the necessary data to build a very meaningful internal audit plan, and IA in turn will provide risk with the necessary line of sight which risk needs. So which can include a lot of important factors such as what is the root cause of the enterprise, the big ticket risks in the organization, how well are those, the mitigation plans working, how well how effective are they, whether they're meeting their timelines, whether they're achieving the purpose for which we are, spending time, cost and output, money on them. So essentially, they're both going to complement each other in doing their own individual tasks. Now, a common question and a confusion that many organizations, and this is a question, which was in my mind also when we started building our entire risk management framework, is that, so if let's say my organization is not very mature, right? Can I allocate a bulk of internal audit activities, risk management activities to internal audit? Can an internal auditor, a CIO, run parts of second line of defense for me till such time as I can build a robust second line of defense in an organization? Do I really need to, since we already have a robust internal audit function which most mature organizations will have, do I need to spend additional amount of money building a risk management function? Won't that duplicate the work? Won't it sort of add extra cost to the organization with not significant enough added benefit and values? So the answer to that is that no. So the ideal way to run risk management in internal audit is to have Chinese walls and to have two separate functions, because at the end of the day, what they are doing are maybe interconnected. However, they are not roles which can be passed on to each other. They are best performed with Chinese walls in between. However, in situations where internal audit may need to be involved in risk management activities, this is a very sort of interesting and informative diagram which I came across many years ago. This is actually built by the Institute of Internal Auditors of UK, I think, yes, and it's part of our ISO 31000 risk management standard as well. And what it does is that towards the left of the fan, it basically tells you those essentially, risk-related activities which only internal audit should do and which risks should not get involved in. Towards the right, extreme right, it tells you about the activities which are which an internal auditor should not undertake. Those are activities which should purely be done by a risk management function. Okay, so in the event that an organization, so the question that anyone will ask is, in the event that an organization does not have a risk management function, right, or it does not have a very robust risk management function or a very mature risk management, who does those activities if you can't give it to an internal audit head? So the answer is that in those cases, you don't delegate them to an internal audit function head. You will rather, the first line of defense will have to carry out bulk of those activities. Internal audit should not at any point be involved in any capacity in these functions. They may take up a bit of an advisory role. However, they should not be taking any decisions with respect to any of the activities which are listed on the right side of this the fan diagram. Okay, so now to give you a flavor of what is here on the left and right and center. Okay, so in a gist, in a nutshell, what it's saying is that if you are giving the management, if you're setting up the risk management processes, if you are defining the risk appetite for a function, if you're defining a risk response for a function, if you're implementing a risk response, internal audit should not be involved. These are functions best done by risk management. In the absence of risk management, they should be done by the just a second. In the absence of risk management, they should be done by the first line of defense. When it comes to reviewing the effectiveness of risk management processes in an organization, whether managed through first line or second line of defense, it is IA purely that should be doing that activity. So we're evaluating whether the risk management processes are adequate given the nature, the size, scale of the company, whether they are covering all the key risks that should be covered, whether the personnel who are managing these risk functions are have the right skills and capacity and capability to do the jobs that have been assigned to them, giving assurance that so basically net giving assurance on the risk management processes, people performance is an activity that should be only done by independent audit function. So this is an activity which risk management committees, audit committees, governing bodies in an organization heavily depend on internal audit to do, and risk management should have nothing to do with these activities. Okay. Now there's that little gray area in the middle. So those are essentially a set of activities which are basically overlapping between risk management and IA. Those are activities essentially related to the risk management function where IA can be involved with a certain amount of, actually adequate amount of safeguards. So they should be playing the role of a facilitator, of a guide, probably a championing the risk management activities in an organization. At no stage should they be involved in any decision making or in any implementation activities. Okay. So net, what we've seen here is that when you're integrating risk management and internal audit, it's important to know what IA should do, what risk management to do, and what they can do together. What are the set of activities they can do together? However, since they are risk management related activities, IA should be involved in those with a fair degree of safeguards where they are not taking any decisions. Okay. So let's move ahead. So what this slide essentially is going to help us understand is that you must have heard of first, second, and third line of defense through the various presentations since yesterday. So with respect to risk management activities, what this slide essentially brings out is that if you take risk management as a function, as a process, as a business, right, for an organization, what the first line of defense is supposed to do is that they're ultimately the owners accountable and responsible for all the risks in the organization. It is not like if you set up a risk management function or an IA function, the risk moves on, the ownership of risk moves from them to the second or the third line of defense. No, it stays with them. So it's their business, it's their function, it's their risks. They need to manage it, they need to respond to it, they need to mitigate it. Okay. So building mitigation strategies, implementing mitigation strategies, identifying new risks, ensuring they're on top of all the emerging risks, all of those activities have to be done by the first line of defense. So the first line of defense should have risk champions within its own function, which are designated people who are responsible for ensuring that all of its risks get identified and highlighted at the right levels at all points in time. Okay, so once this identification has happened, the mitigation plans are in place. So the question is that first line of defense is doing everything. Why do you need second and third line of defense, right? what is it that they're going to achieve out of it. Okay, so they now they also have important roles to play. What is it that second line of defense does? Second line of defense essentially sets up a risk management policy and framework across the organization. Okay, so why do you need this policy and framework? I mean, just about 5 minutes ago, Preeti was asked this question on what are the risks, what are the number of risks an organization should look into? Should we pick up 10, 20, 50, 100? How do we decide what to pick up, what not to pick up, what to defer? So essentially, this policy and framework is going to guide everyone across the organization in building a standard construct on deciding what risks are high, medium, low, what should be picked up, what should be highlighted to governance, what should be highlighted to mid-management, what should be kept at the base with minimal oversight of second line. So those are important decisions which through various heat maps, through various structural constructs in terms of risk assessment criteria, in terms of setting a risk appetite, setting up risk tolerance limits. Risk management as a second line of defense helps us to. So besides setting up the policy and framework, what it also does is that it builds the reporting requirements around, it coordinates and builds the reporting requirements around risk management activities. Because as we saw in the first slide, there is a lot of requirement from governance to report on the effectiveness of risk management. Now, how do they do this? I mean, they are not sitting in the organization every day overseeing every activity. So how do they get the comfort that they can say that, okay, risks are being managed effectively? This is where the second line of defense comes into play. They have to ensure that basis the policy and framework that has been built, risks are being managed, and then ensure the right amount of reporting to the management, senior management, and the governance at various levels to give them this comfort that, okay, these are my risks, top risks, and this is what we are doing with respect to those risks, and these are my gross risks after my consolidated mitigation efforts and responses. This is where I stand today. This is the target that I. So a lot of parameters that you need to give them both visibility of, insights into, as well as comfort of. This is what the risk management function does. It also helps in. It also plays an advisory role in. Advising the first line of defense if they feel that the mitigation strategies are not effective enough, if there are certain gaps. Also helps them guide in identifying risks if they feel there are certain risks which should come out given the way the scenario is, internal, external factors changing. So that's essentially what the first and second line are supposed to do with respect to helping each other. Now, where audit comes in is that there's a complete Chinese wall. It does not play any, so I should not say that it does not play any advisory role. Its first primary responsibility is to audit and review what first and second line of defense are doing and give comfort to governance again that when they are saying something is effectively being managed, policies are being complied with, risks are being mitigated effectively, are they feeding the right amount of data and the right amount of insights to the governance. So they will review the effectiveness of all the efforts of the first and second line of defense with respect to risk management activities, and then report to the risk management committee, audit committee, whoever's the designated committee looking into reviewing IA activities. So audit, as part of its annual audit plan, will include an audit on efficiency of risk management processes so that they can give the governance this assurance. So that's how we tie in first, second, and third line of defense when it comes to managing risk management activities. Now, the question is, we understand that we are doing, everybody with respect to risk is doing their set of activities, and what are ultimately the benefits that we are trying to achieve out of a separate risk management and a separate internal audit plan, which are sort of joined to the hip through the exchange of data and information. So I'll give you a practical example. Now, as Rishabh mentioned, I work for this company called Naira Energy. We are a downstream refining company, and so every 3 years we have to shut down our refinery for about 30 days, and we have to carry out some heavy duty maintenance. 30 days of downtime for us is a huge revenue loss. And when we do this turnaround activity, it's like a planned maintenance for all our critical units. So we have to make sure that our turnaround KPIs are met, and there's absolutely no room for any slack. There's no room for overshooting timelines and surprises as part of this turnaround activity. So it has to be, the management has to be very watertight, and we have to ensure zero non-compliances to anything, whether it is technical, procurement, staffing, everything has to be seamlessly managed. Okay. So what ERM is going to do, EWRM is going to do, is that it's going to make sure that we recognize that meeting turnaround KPIs is a risk on my risk register. It's going to make sure that this risk is adequately plotted, recognized, and my risk response plans are in place, whether it is in terms of building robust, turnaround management softwares, ensuring procurement is happening on time. So there's a set of mitigation plans that we've identified, and we sort of populate those, and we probably assess to make sure that whether they will be adequate to meet the risks that I'm talking about. Now, where does IA come in? So IA is going to do, because with its visibility to details, right? With its focus on processes and controls, will deep dive into the mitigation plans which have been identified as part of the risk management activity, and make sure that those mitigation plans are effective in managing the risk at hand. So, for example, if I'm saying that my planning process involves a weekly update, which starts 6 months, let's say 6 to 9 months before my turnaround activity is going to commence, what IA is going to do is that as part of its continuous monitoring process, for 6 months before turnaround is initiated, it's going to every month go and see, what am I doing as part of my turnaround planning process? Are people adequately involved? Am I building it up as I reach closer and closer to my turnaround date? Is my procurement happening on time? Is my staff in place? Has all the have the labor contracts been put in place? Has migratory labor moved, and is it physically present where it needs to be? So a lot of things. Have all my imported equipments been sourced? Are they on time in terms of landing into India? So all of these depth and detail, it can help me give visibility of, so that ultimately, if there are any gaps and if any additional risk responses need to be planned, risk management team can take inputs from the gaps that they identify and ensure that those additional risk responses get captured and people start work in that area. So this is true for any kind of risk. What I'm trying to drive at is that first line of defense starts with identification of risk and response plans. Risk management activity ensures that those response plans are adequately documented with proper timelines, responsibilities, and ownership. And then IA will ensure that they are functioning and they are moving as planned in terms of implementation. So the three together will ensure that my whole picture is complete. Okay. So I've tried to sort of populate here some of the benefits of this integration to risk management, and what we're trying to say is that IA will help risk management in fact governance and the risk management process itself get an understanding of how effective they are with respect to their processes and strategies through the risk management review that IA will plan as part of the internal audit plan. Risk management can review IA to evaluate effectiveness of mitigation plans, like I just said a little while ago. risk management can also take inputs from IA in terms of advice on identifying and evaluating certain risks which may come up as part of their internal audit reviews, which may not have been populated in the risk registers. So risk management can also ensure that it can make use of IA to ensure a comprehensive risk coverage as part of the IA plan to make sure that all of its risks get covered by IA through their yearly audit activities, so that whatever insights they need on any of those risks can come back to them through the internal audit reviews. IA can play a very facilitating and a very coordinating role with a lot of so a lot of our organizations don't have very mature risk management functions, right? So at that point in time, IA can play a very facilitating and with respect to giving their inputs on defining the ERM strategy, with championing a lot of establishment of a lot of ERM processes, with helping them run workshops, with helping them act as a central coordinating support function till such time as ERM becomes like a robust and a mature organization. It can actually champion the establishment of the whole ERM process. And of course, there's a lot of knowledge sharing between the two departments, which ultimately is going to benefit both. Okay. So now, similarly, just as we saw that risk management, tends to benefit, IA, of course, will tend to greatly benefit from this whole activity because IA tends to be a very detailed function. So it's very easy for IA to get lost in, in a lot of detail and data and lose focus on big ticket items. And so what risk does is that ERM, through its focus on big ticket top risks for the organization, through its various matrices, which help to put the big risks in the right perspective and on the radar, so if IA builds a sort of risk integrated audit plan, IA will be ensuring that it retains focus on all big ticket items and does not lose visibility and sight of what is important for an organization, right? So that increases the impact of IA as a function as well, because this is one question which every governance will ask an IA function, that show me how have you covered all the top risks of an organization in your IA plan. Now, to be able to tie in that, that entire picture is very critical for any audit head. He can't be seen dwelling through the year on operational functional issues, not having, while those are important, but equally important, in fact more important, is to first ensure that your big ticket top risks for the organization are adequately covered into your internal audit plan. So in terms of giving visibility of where the focus should be while building an IA plan, I think risk management has a huge amount of role to play for internal audit, and as a result, it's very important for the two to stay connected at all points in time, to continue sharing data and thoughts with each other at all points in time, to have joint meetings at the time of setting up internal audit plan, at the time of when the risk registers are updated and whatever new risks come in should be fed into the internal audit department. Similarly, internal audit, when they do their reviews and they find risks which are not populated into a risk register adequately, I mean, they could be medium, high, low, whatever, but they should give the necessary inputs into the risk management functions. They should complement each other. They should make sure that they are working in a very integrated, cohesive manner for the purpose of ensuring that my entire universe of risk is adequately managed in the organization. So now the question is, what if we don't integrate? Well, see, the point is, today both IA and risk have to work with visibility of risks. So the starting point for building an IA plan as well as the risk activity is to figure what are the top risks for an organization. If they don't talk to each other, then they'll both be duplicating the effort. They will both be building ISDMs. They will both be sitting and talking to stakeholders for the same set of data. So it's very important for them to speak to each other and for IA to take the necessary risk info from ERM rather than initiating the activity in its own silo. if they don't integrate, there is a huge possibility that certain enterprise-wide level important objectives will get missed out, and in terms of its focus on transactional financial compliance related details, I may not focus on them as adequately as it should. So risk prioritization, ensuring the right focus, emphasis on important threads of an organization can only happen if both of them are well integrated and talking to each other all points in time. Yeah. So here what I'm trying to show is that, so these are two support functions trying to meet the same roles through their set of activities. However, the deliverables in an organization are largely, they look very different, because on the left, you'll see what a risk management function will ideally deliver. On the right, you see what an internal audit function will be delivering. So a risk management function will essentially give an organization visibility into the risk profile, how many high, medium, low, intolerable. There can be various matrices, heat maps that, that different organizations will have a different one for themselves, whatever suits their needs and governance best. But basically, risk management will tell you what is the risk profile of your organization, how it has changed over previous month, previous quarter, high risk going up, low risk going up. So all of that, red, medium, amber, where am I vis-a-vis my target risks. So, however, what an internal audit function will do is that it will be more detailed. It will pick up specific risks and it will go into the root cause of these risks. It will give you, it will agree with the management on what mitigation plans should be put, what additional mitigation plans should be put in place if there are any gaps. It will take timelines, and then all of this can be fed back into the risk management function. Now, the one important thing when they're doing these activities and giving out their output is, and this is something which gets missed in some organizations where risk management is not very robust, is that when risk is building a heat map on a high, amber, low, and internal audit is building its audit report rating criteria, those should be married together very, very seamlessly. IA should not be using a different parameter for rating its risk, for example, a cyber risk. I mean, IA should not be rating it differently from a risk management function. So whether it comes to ethical risks, whether it comes to cyber risk, whether it comes to financial risks, if something is critical for a risk management function, it has to be critical for an internal audit function also. I can't say that I'm sitting on 100 million as significant for me from a risk management perspective, and it's completely intolerable for me from an internal audit. You have to have the same set of quantitative and qualitative risk assessment criteria for both the reports to to enable the governance to draw similar conclusions from the underlying assumptions. You cannot have a different set of assumptions between these two functions. So integrating the rating criteria to the internal audit report rating criteria to the risk assessment criteria is also a very critical objective that needs to be met in an organization for effective integration of the two functions. This is just some little example of what a risk management output on a PCP review could look like. So while risk management will populate all the necessary elements where dependencies lie for an effective business continuity plan in terms of men, material, machinery, management, what IA will do is that as part of its review, it will give a rating of what part of this activity is well streamlined and where are we at risk on account of the gaps that exist. Similarly, another example that is I've identified a risk event as increase in raw material price as a possible risk event, which can affect achievement of my business plan as part of my risk activity. Then I will lay down various, control factors which are very important to ensure that my risk event does not materialize or gets mitigated if it materializes. And then what IA can do is that it can review how many of these have been effectively implemented in the organization as by building it into their internal audit plan. So that's how these functions, two functions complement each other. So I think that brings me to the end of my presentation. So I hope I've been able to leave you with adequate thoughts on the fact that these are two critical functions an organization should have, best run through separate, sort of functions with Chinese walls, but effectively integrated through exchange of thoughts, data, and output. Yeah. So, Murtaza, over to you and the team for any questions.
Great. Thank you, Aarti, for such a seamless presentation. Sachin, at least 2 questions. There are many in the chat box, but we'll take at least 2.
Sure, Murtaza. So, Aarti, one question is, as 3 lines of defense model is fading out, would it be more practical to merge internal audit and risk management?
No, so as I explained, I think through various examples as well as through an explanation on the fact that even statutorily we are required to, so there are many statutes today which require a company to have both a chief risk officer and a internal audit officer, right? So it's not a fading concept, in today's time. In fact, it's becoming increasingly important to have a very robust second and third line of defense for an organization, because as we are more and more seeing, leaving the management of risks to the first line of defense does not work very effective when it comes to giving governance the comfort on how these risks are being managed. So more and more organizations today are feeling the need for a very effective and robust risk management function to help them identify, assess, and manage their risks, to set up the right risk appetite for their organization, to set up the right risk tolerance levels for their organization. So these are all, sort of concepts which are really picking up now. There is more and more being added to the entire risk management activity as we speak. I mean, a lot of organizations are building in the concept of not just measuring gross and net value of risks, rather they're looking at the target level of risk, given that they're saying gross risks are a very dated concept now, because every organization will have certain mitigation plans put in place, so they will not leave risks at a gross level. So what essentially you should look at is the net and the target value of risks. Velocity of risks is also picking up, that's a concept which is picking up increased amount of importance. So what I'm trying to say is that risk management as an activity has become fundamentally very important for an organization, and it has to be supported by a separate function. Internal audit, of course, is it's a regulatory requirement. You have to have an independent body giving assurance on the processes, compliances. So you can't, you can't do away with any of the two.
Yeah. One interesting question. So there are many. Sachin, sorry, I'm taking one from here. If an organization has an internal control or operation risk team which works as business partner with process owners,
right,
does IA team have right to obtain output of reviews carried out by such team? Can these teams decline sharing output of the review, and are they right in doing so considering Chinese wall?
Okay, so when we say Chinese walls, I think we should refer back to that fan diagram. So Chinese walls have to be maintained with respect to the set of activities that should be done only by IA and should be done only by risk management. So I explained why you need to keep Chinese walls, right? The Chinese walls should not be kept with respect to sharing of knowledge and data, because that is very critical to ensuring integration. Now, if an IA is going to sit in his room, IA head is going to sit in his room, and risk head is going to sit in his room, you're going to be duplicating efforts. You're going to make the whole process self-defeating. So what governance wants today is that, and what in fact, we've got some very noted personalities in our risk audit committee, and their ask every day is that please risk and IA talk to each other on a regular basis. Please exchange data, please exchange thoughts, because ultimately they are trying to achieve the same output from both of us, right? So we are both trying to get to the same place through different sets of activities, right? So you cannot have Chinese walls with respect to sharing data. You can only have Chinese walls with respect to the activities that these two are supposed to do. Yeah. So that's where yeah. Anything else?
Great, Aarti. So there are lots of questions, but I think what I'll do is request the WRC team to mail you the questions.
Definitely.
If you can just send us the answers.
Sure. Thank you so much.
Thank you. I request
Thank you so
my
much.
colleague coordinator, CA Rita Chitle, to carry out a much well-deserved vote of thanks. Rita, over to you.
I'll just say one word was superb. That was one word which came to my mind. See, your
So
thought, unambiguity of expression is just marvelous. This is such a
thank you so much.
this is a very sensitive topic because I can and the best part what I liked was the expression of cats and dogs. These two departments.
Yeah, I'm telling you, we're all feeling like dogs. There's so much homework we are doing, office work we are doing at home, homework we are doing at my.
Yeah, that was
We
really.
become like dogs. Thank you, Rita. Thank you so much. I have enjoyed making the presentation. I hope some people have benefited out of some thought clarity from this. Thank you so much. Thank you.
Thank you, Aarti.
Bye-bye.
Would like to be grateful to you. Thank you. Thank you, Aarti.
Bye.
So with that, we will move on to the panel. And while the panel comes over, they switch on their camera and we introduce them. If someone wants to take a break, can take the break. Welcome, Nilesh. Welcome, Rajiv Newar, Pratik Shah, Jas Damani, and Pradeep ji. I think he's got some challenge with his video. So for the benefit of the participants, we have two CFOs in Rajiv and in Pradeep Menon, and they are going to tell us what do they expect from internal audit, what do they want the internal audit to cover during the course of the year, how frequently they want us to change a plan, and what is their expectation from us. We have two seasoned, and again let me tell you, Rajiv comes from hospitality and Pradeep ji is with Pidilite, so completely different industries. Here we have Pankit, the audit head from the technology side, and we got Nilesh Likite from ACC, and he's again on the brick and mortar side. So both the internal audits will tell us how they prepare the plan and what changes they made during COVID time. And then we have the all-rounder, Jas Damani. So he leads the risk management function, and he's going to get the maximum out of all the panelists. So welcome all of you, and thank you very much for your time. And I request Sachin to please introduce Jas. Sachin, over to you.
Thank you, Murtuza. So with the context being set by Murtuza, my pleasure to introduce Jas Damani. Jas is a chartered accountant and has overall experience of 7 years across diverse functions, including corporate finance, business transformation, governance, risk and controls. He currently heads the corporate risk and internal controls portfolio at Godrej Industries and is associated with the other companies in the group such as FMCG, real estate, animal feed, and agrochemicals. Prior to Godrej, he was working with Reliance Industries, where he handled various roles in the petrochemical and retail businesses. He was part of core task force for implementing business transformation at the polymer business unit. He is a keen propagator of governance through the system and is hands-on implemented GRC solutions. Jas has also been recipient of Outstanding Newcomer Award at Godrej Industries for setting up a framework on reporting macro environmental risk insights along with the business impact. He is instrumental in calculating data-driven risk and governance practices across group companies. Pleasure to have you, Jash.
Thanks, Sachin. Thanks, Murtaza. Pleasure to be on board today. I'll just introduce the panel. So we have Rajiv Newar. Rajiv is a chartered accountant and a company secretary. He was a college topper in BCom honors from Calcutta University in the year 1990. Rajiv has also received certifications for management and leadership programs from Cornell University, University of Michigan, Indian School of Business, and IIM Ahmedabad. He has approximately 3 decades of diverse experience, having worked with leading business houses such as the Tatas, Birlas, and K. Raheja Corp in various leadership roles. As Executive Director and CFO for Chalet Hotels Limited, Rajiv led the company through a successful IPO recently. In his stint with the Taj Group of Hotels, Rajiv has led many initiatives and played a pivotal role in implementing the growth strategy for the business. He is a recipient of several awards and recognitions, such as Tata Awards for Business Excellence, and has also been recognized as India's most admired CFO by WPI. So welcome, Rajiv. Glad to have you on board.
Thank you. Thank you so much.
Our next panelist is, yeah.
So I said hello to all the panelists. Yes.
Right. Our next panelist is Pradeep Menon. Pradeep is a qualified chartered accountant and cost accountant and was placed in the national merit list by both the institutes. He is currently the CFO at Pidilite Industries and has over 27 years of experience in the consumer packaged goods, paints, as well as IT services industry. Prior to joining Pidilite, he was the CFO at Mindtree, as well as CFO and Executive Director at AkzoNobel India. Pradeep has worked for over 2 decades with Unilever in multiple roles. In 2016, he was recognized by the CIMA as one of the most influential CFOs in India. Pradeep's inspirational quote is, "Conquer yourself and the whole universe is yours." So with that, I would like to welcome Pradeep to the panel. Welcome, Pradeep.
Thank you so much for the opportunity.
The next panelist is Nilesh Likite. Nilesh is a chartered accountant and cost accountant. He has further pursued CISA from Isaka, USA, and is a certified internal auditor from Florida, USA. Nilesh has an experience of over 25 years in the fields of internal audit, risk management, corporate governance, corporate fraud investigations, ERP implementation, and procurement systems. Nilesh is currently the head of internal audit and investigations at ACC Limited, which is part of the Lafarge Holcim Group. Prior to joining ACC, Nilesh was heading the internal audit function at the Wadia Group and has also worked at Reliance Industries in the field of management audit and IT tools. Nilesh is active in social services and community development activities through the Rotary organization and is a past president of the Rotary Club of Thane Hills. Welcome, Nilesh. Glad to have you on board.
Thank you.
Next panelist is Pankit Shah. Pankit is a chartered accountant and a company secretary. He has more than 9 years of rich experience in internal audit, SOPs, internal financial controls, and compliance management across the secured logistics, manufacturing, media, hospitality, insurance, and FMCG sectors. He currently leads the internal audit and SOX function at Brinks India and has prior experience with EY and KPMG in risk advisory services. He has spearheaded the implementation of industry best practices and various cost-saving measures during the COVID-19 pandemic for his current organization, Brinks India. He has also received various awards, such as Team Accelerator and Kudos Awards at the organizations he has been associated with. So welcome, Pankit.
Thank you. Thank you, Josh. Thank you.
So to begin with, I felt it would be most appropriate to reach out to the two CFOs that we have on the panel. So my first question is to Rajiv and Pradeep. So there are two parts to it. So A, can you throw some light on the impact that COVID-19 has had on the industry in which your companies operate in? And B, because of this, as CFOs, what are your expectations from internal auditors? How do you position internal audit as a function that can add value to the business in the new norm? We can start with Rajiv, please.
Okay, good evening, everyone. See, I think the first thing that comes to my mind is that what COVID has done is done one thing. What it has done is basically it has impacted revenues, as simple as that. when revenues get impacted and you can't do much about your revenues, the next thing that you do is basically, and more importantly, when revenues get impacted and the realization is that revenues are not going to come back quickly, then you have to revisit your cost structures. And what I've seen is the whole industry, what it has done, it has been able to revisit the cost structure and make it more nimble and make it more frugal. So let me give you one or two examples to make this understanding better. In this industry and in the hospitality industry, and likewise in mostly all the industries, normally we will always come across costs which are considered to be fixed and certain costs which will always be considered to be variable. And when business moves up and down, we always expect that the variable cost will move up and down and the fixed cost will remain fixed. But what COVID has done is it has got every company to look at the cost structures very, very closely. And lot of costs that were always hitherto considered to be fixed have now been considered to be discretionary. Or a lot of fixed costs have actually become variable. I'll give you an example. For example, talking about power cost, there is a minimum demand that you may have. Now, the minimum demand cost could be a fixed cost for you. You won't even look at it when your volumes operate at a certain level. But in these times, you would look at your minimum demand cost also very differently to bring it down to a level where there is no wastage. Your AMCs, which were often a fixed cost for you, annual maintenance contracts, you would kind of bring it down to see which are the AMCs that you need to be fixed and which are the AMCs that you can do it on call basis. That means you don't have to have a fixed cost. So more and more companies are kind of moving the cost structure from fixed to variable. That's one. And making it more modular. So as revenues will start ramping up, the cost will also start ramping up. That's how it is. And I think it will not be wrong to say that the way I see the business going forward is that business was today more internal. That means all the functions were internal within a company. But going forward, I can see an ecosystem of functions. That is how the business will evolve. That means you don't have to have an HR function as a part of your company. It can be a modular function which can be, kind of bolted on from an external firm. A finance function which could be added on. Marketing function which be added on. So it will become a bouquet of modular functions. Then all the functions remaining within the company is the thinking which I see going forward. Talking about the second question very quickly. See, my view is that an internal auditor normally reports facts and figures. I call that auditor a very average auditor. Then I will define a good auditor, good internal auditor is someone who I would say also adds this with an impact analysis. But again, he's not an excellent internal auditor. So who is an external internal auditor is what a CFO wants. Two things. A good an excellent internal auditor is someone whose scope is completely mapped with the risk matrix. So if the organization has a certain risk matrix, whether it is a strategic risk matrix, whether it's operating, it is completely aligned. The scope and coverage is completely aligned. That's one. And two, he does not give me a 40-page report. He looks at all the facts and figures which form a part of the annexure. They don't form the report, they form a part of the annexure. And what he gives me are only 2 pages of action points. And those action points should not be unilateral. Those action points should be well researched and discussed with the stakeholder. If an internal auditor is able to do these 2 things, I call him an excellent internal auditor and the kind of internal auditor who a CFO would love.
Fantastic. Well, very well said, Rajiv. And with that, let me move over to Pradeep. Pradeep, could you share your views on this? Pradeep, are you there?
I can see him. He is unmuted, but we can't hear him.
Okay.
Pradeep ji? Maybe there is some network issue. We can cover him later and go to the other panelists in the meanwhile and come back to him.
Sure, sure. Okay. Right. So let's move forward. I think my next question is for Nilesh. Nilesh, as Rajiv very rightly said, that an excellent internal auditor is one who proactively links the risks to the audit plans, and that is maybe a given in the new normal. So my specific question to you is, has the pandemic helped you ideate new ways of approaching audits? Have you thought of going back to the drawing board and revisited audit plans, in order to focus on specific areas, maybe something not generally covered in the routine course? Nilesh.
Yes, thank you for this question. And certainly the answer is yes. It required us to relook at our audit plan. When we talk about internal audit, it is existing in all the industries, right? It is into very new generation companies like financial services and retailing, where the use of IT is very much integrated into the operations as compared to very age-old commodity-driven companies where the level of digitization is not very high. Certainly in my company, we need to have a relook at our plan. Our plans are typically location-based, and this is what traditionally the internal audit is being. If in my earlier days or someone before pandemic, if I see my audit team sitting at his location for a longer time and trying to get the data over phone and all these things, I will stop at him and say that, boss, why are you not going to the location and getting the data? Even when functions like treasury and procurement, which are in our premises only. So the audit was also happening in that particular location, closer, and taking the data, understanding the locations very close. Wherever coming to the plant audits or sales unit audits, always the team used to travel and be there for at least 2 to 3 weeks. And in that also, our emphasis was always to leave the audit room and go to the actual departments like mining and the procurement, the production and stores and so many things, way bridges and all these things, to see the process and visualize the process and see that how it is transferred and the controls over it. So it was all kind of a very location-based audit. Now, whole concept and a whole methodology is suddenly gone up with this travel restrictions, and we are not able to travel. So immediately, what was the need is to identify what we can do by using the data and inventory of all the digital records within the company, soft copy data, and also the need to collaborate through video conferencing and document sharing. So what we did, basically, we had a risk-based audit plan, which is not the whole audit, the risk-based audits. So within that, we reprioritize the audits with identification of the must-be kind of areas, line with what Rajiv mentioned, that align with the high risk already identified by the business, and also do away with the where we have not as a matter of only additional assurance. So what we did is we converted our similar process audits at different locations to PAN-based audits on data analytics, and we also did the opening meetings with a clear focus on remote auditing and how it will be done and what is expected from the auditees. We also see that the routine audits, basically I already mentioned, converted to database audits with the analysis of data exception. So what we did is rather than seeing the process and then identifying whether it is the issue in a walkthrough, we migrated ourselves to getting into the data, identify the data exceptions and concentrate on those areas rather than going through the full system review. And at the same time, we need to also ensure that this change methodology has gone into any shortcuts. The coverage of assurance which is required is actually widened and not impacted due to these changes. So certainly also the new audits which we did in this course is shifting from location and focusing on the entire process with the exception analysis. So we did so basically six audit already we were doing, but with a new focus and with a new face, we are approaching these audits in this pandemic.
Right.
I can mention. Jay.
Right. Thanks, Nilesh. So I think you gave us very pertinent examples of how internal audit can be made more agile, so to speak. So speaking of digital tools, video conferencing, remote auditing, all these concepts which are increasingly significant in today's new normal. Let me move over to Pankit and get his views on management of cybersecurity risks. Pankit, so all of us are working from home, and an area that needs due credit is effective management of cybersecurity risks and controls. So based on your experience, could you speak on this area a little bit and give us some examples and best practices on mitigating this risk, since you come from a secured logistics industry and you have of course your various other experiences in various other sectors. So could you speak on this?
Just sorry for the interruption. Just Pradeep ji has joined in, just for your info.
Okay. So I think Pankit, we'll you can respond now, and then we can come back to Pradeep ji.
Yeah. So thank you, Josh. So yes, this work from home scenario has basically pushed us to work on the cybersecurity risks also, which were always part of the processes, but were not so critical, which have now become critical because of remote access tools and video conferencing and you can say data analytics tools that have come in. So yeah, so in the work from home scenario, obviously the remote working policy plays a very important, you can say, role. Especially, you need to basically jot down what process needs to be followed for the approval of work from home. There needs to be clear, defined roles and responsibilities, as in who will be given access to which kind of tools, because there will be different kind of tools available and different kind of tools required for communication within the organization by different teams, including the internal audit team. And there are certain risks that need to be covered, especially the network defense as well as the anti-phishing tools that need to be strengthened. So there needs to be a technology around it, and especially, so I'll tell you from my example, we have invested a lot into CB defense, carbon black defense mechanism, which helps us basically mitigate the anti-phishing as well as network defense risks, and it accurately detects and blocks such threats. So, and there needs to be a process of training and guiding the employees on how basically what should they do in case they receive such kind of emails wherein anti-phishing activities are being done, whom they should reach out to in case incident occurs during during the usage of such tools. And there should be mandate of use of VPN, right, for security. We should be offering the right tools to all the employees, especially the VPN, built-in encryption tools, built-in firewalls. So all this becomes a lot more important when it is a work from home scenario, and there should be continuous trainings on how these tools have to be used securely. And like you said, so in our secure logistics setup, we basically use these phone devices to do a lot of data entry on field, wherein we have gone ahead and taken tools to secure the data on the phones as well, because you don't want those data to get accessed by unwarranted threats, right? So that is also very critical, wherein you invest in strong tools around to block these cybersecurity.
Right. Thanks, Pankit. I think that was very well put. So let's come back to Pradeep. Pradeep, just to come back to the initial question, which which Rajiv has already given his feedback on. I'll repeat the question.
No,
So there
it's
are two
fine. Sorry,
parts to it.
apology. No, I've got the question. I'm
Okay.
sorry for the technical issue. I'll just quickly summarize in the interest of
Right.
time. So, as many of you know, Pidilite is basically in the business of adhesives, sealants, and construction chemicals. And we are not really in any essential services or commodities, and therefore, to that extent, we have a significant correlation with the economic activity in the country. So, when COVID hit us, we were significantly impacted. April being a complete washout, and then there's been a gradual, sort of improvement in the business as it is, not. Some of the elements that we are seeing is parts of the business where it is, where it do it yourself kind of categories coming back. Some of the rural areas coming back faster. How metro and so on and so forth have been weaker. We've also had a number of challenges in terms of supply chain, whether it is in terms of warehouses or factories. And last but not the least, in the business side is the people part, which is core to our strategy. We have used this opportunity to really leverage technology and enable work from home through Microsoft Teams. So because of that, technology has really helped us to connect with our people and with the users, customers in the marketplace. Overall, we believe it's a health crisis. Things will only come back to normal when there is a vaccine found and the consumer confidence will be back. Only when there is money in the pocket to spend. From expectation of the internal auditor, I would say that the internal audit function needs to recognize the massive external change which has happened. Some examples, process changes which have happened, including change in purchase to pay process and so on and so forth. We've had significant changes in terms of the risk in the business, and therefore, are people comfortable, reviewing, and is the audit function and the risk function, looking at all the risk with a pair of eyes, prioritization of the audit plan, and last but not the least, supporting management during this process in terms of compliance, whether it is the safety, health guidelines, and so on and so forth, which is critical for the business. So I think that's the question. I'm not sure I was clear, or there was some disturbance in the background.
There was, I think, slight disturbance, but I think Pradeep, I think most of your part, I think you were pretty much clear, I suppose. So thanks, Pradeep. Thanks for your thoughts. So again, moving back to Rajiv. Rajiv, our panelists, Pankit and Nilesh, they spoke about supply chain, and even Pradeep for that matter. They spoke about the changing supply chain scenario. Nilesh spoke about how long or routine visits to plants or any other sites, they've cut down on those because of the travel restrictions and are working remotely. Pankit touched upon cybersecurity. So I think how do auditors or how do internal auditors ensure efficacy of SOPs? All of us are familiar with the time, resources, effort involved in preparing these documents. It sometimes take months together. So how do we ensure that SOPs are effective and working on the ground? Could you share some learnings from your own experience?
Sure. And this experience is not recent. This is a experience over the years. Very often I've seen, I just give a little bit of context here, a 2-line context before I jump into the answer. You see, very often I've seen that in the name of SOPs, people write a Bible. And if I was to just take a step back, and I'm a great believer in a management tool, a strategic tool called the balanced scorecard. And the balanced scorecard has various principles. I'm just going to use one of them here, which is called A, letter A, D, L, and I. Anything and everything we do in life has 4 stages: A, D, L, and I. A is the approach. D is the deployment. L is the learning. That means when you deploy, you realize something went well, something did not go well. So there is a learning. And I is the integration. Basically, the learning then goes back to the approach. So A, D, L, I in your personal life or professional life keeps getting repeated. Now, when I talk about SOPs, they form a part of A, which is the approach. Now, if I may take a step back and ask you, if my approach is 100%, but if my deployment is 20%, your product is 20%. 100 into 20% is 20%. Let me give you another example. Your approach is 60%. Your deployment is 80%. Your outcome is 48%. Right? Now, what I'm saying is that it's very important to be perfect, but it is also important to be practical. Now, why am I building this up? I'll tell you now why I'm building this up. My approach towards SOP has been always 3 pages, or rather 2.5 pages. So the first page is basically a flowchart on an A4 size paper. If you can't, and I can challenge you, and anyone can challenge me, give me any process, we can convert it into a flowchart in an A4 size paper. Okay? Not by writing small letters, making it more meaningful. Number 1.
Right.
Number 2 is basically a schedule of authority. Who is authorized to do what and at what level? And C is basically RACI, R-A-C-I, which is an acronym of who's responsible, R, who's accountable, A, who needs to be consulted, C, and who needs to be informed, I. So every SOP, I have often been seen that people have come to me with such a thick SOP. I said, thank you. Goes into the dustbin. Sorry, no offense meant. Beautifully written. I'm saying we are not here to write a literature. We are here to write an actionable SOP. An actionable SOP can only happen if it is crisp and brief.
Absolutely.
So, if this approach has been followed, then the understanding becomes objective. Deployment becomes objective, and the verification also becomes very objective. So our SOPs don't have jargons. Our SOPs don't have any kind of, we don't make it very confusing. Very simple. So with this clarity, we have identified all the risks in the business. We have identified all the controls in the business.
Right.
Every control is mapped to a risk. So what the internal auditor needs to do is to only check the risk, check the controls. There are 3056 controls. And let me give the credit that when I was with the Taj Group, this was actually conceptualized at that point in time. When I moved on, I was a part of that. I evolved it and I have implemented my subsequent journey as well.
Fantastic.
Okay.
Fantastic.
Now, most of these controls can be validated online. So it has not been a challenge to, once you make things objective, validation does not become a challenge. Now, there are a couple of things, for example, like a physical verification of inventory. People could not go to the sites to do a physical verification of inventory. So we did a video, and there was this person out there who would be told at random, go there, go there, go there, look that, look this, look that. And believe me, through remote access, through a video, just like we are meeting today, a lot of these internal audits which needed physical presence could be done remotely. So there is always a way to do these things, and materiality did play a role, impact analysis did play a role, and it was being done very effective.
Great.
Sorry,
I think no, that's fine. I think it would be pretty much useful to all participants, and it was a very pertinent example that you gave. Physical verification through a video is something really unique. That's that's been done.
And most applications you can have remote access. Most applications you can have remote access. So it is always possible to kind of do audits remotely today.
Absolutely. So let me move on with the next question, and Rope and Pradeep, and after Pradeep response, we'll just have a quick take from Nilesh. Pradeep, as we again we're working remotely and working from home, and with all the restrictions on travel, etc. What do you think is the role played by analytical tools, and how effective are these, or how effectively can these be used in internal audit?
So I think the first point is that the analytical tools help the internal audit function to be more proactive and see lead metrics versus post-mortem or lag metrics. I think this is a really sum and substance of the response. The analytical tools enable us to have a continuous monitoring of the business data and also identify certain potential fraud risks and so on and so forth. From an overall perspective, the the analytical tools really help process owners, decision makers with early warning signals, effectiveness of policy, and optimize audit procedures. I think in Pidilite, we are at an early stage of this journey, and we are approaching this using some of our existing tools, such as Power BI dashboards and Excel-based analytics. And we have developed a few such reports already, some of examples, and these are practical examples which you can use, such as journal entries review, one-time vendor payment, truck capacity utilization, same-day purchase order and goods received notes. So these are some of the examples that we have already operationalized, and we have a long list to go. Frankly speaking, the way we see it in the end game, if it is implemented well, this could be a dashboard for the internal audit function to monitor and get risks flagged on a continuous basis.
Right. Okay, understood. Point taken, Pradeep. So Nilesh, can you just pitch in here and give us some examples on analytics and how you guys are using analytics in your day-to-day activities?
See, as I was mentioning in my first response, that we were required to move away from the location-based audit. So basically, in just to have a kind of a lighter note, one of our audit committee chairmen, we have interacted. When we used to present some report which is not very much backed with the data and examples and kind of thing, he used to say that I think this is a kind of example of an armchair audit. Auditors need not be doing armchair audits, but need to be a field auditors, very much on the field and all. But see the situation. Now we are required to be the armchair auditors because of the travel restrictions and this thing, and it has opened up a new door. So if I am and also just to add to what Rajiv was mentioning in the physical verification, in a company like mine, where we are much into a bulk inventory. We have limestone mines where we have to identify what was the amount extracted, quantity extracted, the coal inventory, the gypsum inventory, which is all lying in use and bulk. What we have done is we have deployed drones for physical verification, and the data is kept into the systems and made visible. Even our statutory audits for 2 quarters, like quarterly reviews, have been done using this. Then basically this gives us the opportunity to see what is that we require for the audit and whether it is available from the existing databases to do the kind of gap analysis and have more visualization tools being used. So had done this analysis, like what the business is using. We switched on to using more of our click view based reports for sales and outbound logistics, which is there. For our financial transactions and procurement side, we have SAP BW reports, which we have already. So earlier we were largely ECC reports, which were there standard and customized, but we have also shifted to using this tool which business has developed, and as our usual tool now for audit, because of the example of the project is that we want to be the armchair auditors kind of a thing, without without having the or I can say with the impact of our original audit methodology of having audit observation back to data and kind of.
Right. Thanks, Ines. I think it's interesting to hear and learn from all of you, and I'm sure all the participants also would be benefiting out of this. I mean, using drones, using video-based physical verification. Pankaj spoke about using mobile phones in their operations. Pradeep spoke about analytical driven decision making and analysis and so on and so forth. I think it's very interesting to understand how internal audit is working hand in hand with finance and other processes to sort of evolve in that sense. Great. So I think let's move on to the next question, and this is a pretty interesting area. And I would like Pankit to respond to this. So Pankit, you think that the time has now come for internal auditors to move out of their comfort zones and take up unconventional assignments, so to speak, by partnering with business? If yes, could you share a practical example in this area which you have done? And let me just rope in Pradeep and maybe Rajiv also for a quick sort of thought on this. Pankit.
Yeah. So thank you, Josh. So yes, it is time that we as internal auditors move out of our comfort zone, and obviously partnering with business has now become critical in helping the organizations add more value. So I'll give a practical example. So we are into cash management business, wherein we manage ATMs. There's a managed service providers who own the ATMs, and there are banks as a third level who give us money to replenish cash into these ATMs, right? Now, a lot of times what happens is there are shortages, there are some thefts, or there are some errors due to which the cash in the ATM doesn't tally with what was replenished or what was supposed to be replenished as per the banks. So then banks pass these deductions as shortages, and there are a lot of times cash not coming out of the ATMs and customer raising claims. So then all these issues come up, and there is a ATM reconciliation team within our organization who works back with these managed service providers, and obviously the managed service providers work back with the bank to get these disputes or deductions sorted out, so that it's not a hit unnecessarily for us as cash replenishment agencies, right? So so during this COVID, when this COVID obviously came in, I was asked to partner with the reconciliation head to basically reconcile and streamline the process, because there were a lot of old deductions or old shortages and customer claims pending with a lot of MSPs across the board. So therein, I think 3 months we worked together, streamlining the processes, collecting more evidences, justifying to the MSPs, getting exact reason or root cause analysis for these shortages or deductions, and then the MSPs justifying to the banks, which helped us recovering a lot of old deduction pending reconciliation. And in fact, I can't mention the value of for confidentiality, but we exceeded the target by more than 12 to 15%, which was set by our global management. So that was one of the areas where we as internal audit helped the business team or partnered along with the business to actually add value. So this was one of the ways, apart from cost saving, cost reduction, or optimizing the current processes that we normally do investigations and all. This was the first different kind of project which directly added value to the top line, or
Right.
you can see the profitability of the company.
Right.
So this needs to be more frequent in various kinds of areas. Partnering is a key, and because we come from a risk management or internal audit perspective, it helps the process owners also to look at the current processes, maybe fill in the gaps, and actually practically, when we also have a look along with the business heads, what they need, what they expect out of the outcome, it helps the organization.
Right. So, let me just ask Rajiv to jump in here. Rajiv, could you share some examples of business partnering that you would have done maybe currently or earlier, as in your capacity as CFOs for the organizations?
Sorry, just to get the question right, business partnering, could you repeat that last part?
So the question was that has the time now come for internal auditors to move out of their comfort zone and partner with business in maybe helping the business tide over these kind of crises situations?
Sure. See, I'm going to borrow from some of the answers that I gave earlier and give you this answer. So the first part is that we just defined what is an average internal auditor, good internal auditor, and excellent internal auditor. An excellent internal auditor, one of the qualities I said was basically who combines the risk matrix. The coverage is completely takes into consideration the risk matrix of the company. Okay. Now, I also was listening to the previous session, and one of the questions was, can internal auditors take over the risk matrix? My belief is that risk matrix is a business function. Internal audit is a function that could lead into the risk matrix. The risk matrix is a business function. Okay.
Right.
Now, so the way I look at it is that how the internal auditor could add value is when this risk matrix is completely supported by the internal auditor. That's one. Now, one of the risks is an opportunity loss. For example, you do a business to earn revenues, you incur costs. But if there is a revenue opportunity which you have lost, and if the internal auditor has not caught it, it will not get even reflected. Now, let me give you a practical example of this. we were setting up a hotel, and this happened a couple of years ago. We were setting up a hotel in a location where, so the internal auditor would have gone. He would have seen that what was the approved budget, what is it that has been spent, and if there are any variations, is there a variation to the schedule of authority, and so on and so forth, and report it. But this internal auditor said, listen, I've done all this, but do you know something? There is an opportunity by the government of India where you could claim 40 crore rupees as an incentive because of the location that the hotel is being constructed in.
Right.
Now, had he not said that, it would have still been a perfect internal audit from his perspective, but not from a CFO perspective.
Right.
By doing that, the process was initiated. The money has come in subsequently, but the fact is that that is the value add I'm talking about. Let me give you one quick example, because I feel internal audit should not be transactional. Internal audit should be, it is a means to an end. It has to be business focused. So this was an example where the company had, okay, so you can draw power from the normal source. Let's say you are paying 15 rupees per unit. If you go with the renewable energy, you could possibly get it, say, 13 rupees per unit. And the company was very happy to say, listen, I'm going with the renewable energy, I'm saving 2 rupees. Everybody was very happy. When I was reviewing it, I found out that we were using solar energy, and if we would have gone to hydro, we could bring down from 15 rupees to 11 rupees 50 paisa.
Right.
Now that is a value add I would have expected the internal auditor to do, not just report an Excel variation. Tell me, is this the best solution? Or is it, how do you benchmark? It has to be relative. So you need to tell me, is this the best solution? Or is there an opportunity that I'm losing? And that 1.5 rupees is a very, very significant opportunity when it is multiplied with the number of units. So these are the value adds that one would expect from the internal auditor. And lastly, I would say that in today's day and age, an internal auditor has to be tech friendly or tech savvy, because it's remote. And the SOPs also need to be redesigned to support this work style, and needs to be as much as nimble. And last thing, as I just add one more point, one of the elements in the risk which has now assumed huge importance is a cyber risk. Because of the remote working, the cyber risk has to be phenomenal. Because people are, like, in a listed company, you have UPSI, but people are, having these conversations from respective houses, homes, having the laptops open at their homes, having these conversations. How do you make sure? And not just say it is not being done. Want to tell them how it can be done.
Right. I think very well put, Rajiv. And let's move on to Pradeep. Pradeep, could you share some insights on business partnering and how internal audit can move away from that conventional sort of ways of working?
Mr. Pradeep got logged out and he's facing some technical glitch. So we'll try. We can just pose the question to the other panelists.
So let's move on then. Here, the next question is on digitization. Now, this is, I think, a very, very widely spoken topic, and a lot of emerging technologies are coming up in this area. But taking a step back, I think, Nilesh, my question to you is, can we can we have a quick take on how organizations can leverage their already existing digital infrastructure in enhancing quality of audit reviews, and then maybe move forward in saying what extra digitization is required, or what extra processes can be digitized through robotics and AI and all these other technologies that are available. And then after Nilesh answers, maybe we can just rope in our other panelists also to give their responses in this area. Yes, Nilesh, please.
Just Mr. Pradeep has joined, just for information.
Okay, so Jash, basically, we all know that we are still not out of the pandemic situation, though the activities have been started, and offices have been started, and mostly the operations have been started. This is a time of a quick response and quick action, and hence leveraging the existing technology is essential. This is certainly we can't go for a very high-end technology which we can have in terms of deployment of robotic kind of thing. It is a project kind of activity, so we need to have a lot of project need to be followed. So certainly, the quick way what we can do is look at the existing systems and processes landscape and identify the gaps into what we required the auditor to do the audit remotely and what is available. And if there is a gap which can be filled in by the in-house IT teams, then get in contact with them with our functional requirements and use the data sets to identify the business exception reports. So this will actually reduce a lot of redundancies in the data reports downloaded, getting it into Excel, and then trying to build analytics on this thing, which is largely manual and the use time also. So that anyway is available in a reasonably based companies also, and of course large companies in either of the ERP systems and which are the data tables and relational database kind of models. So data is available. It is important to identify what we want. Like first start point is what is the business exception for a given business, and identify whether it is readily available. If not, then how we can generate those reports quickly. And more importance should be given on visualization kind of files, which has a quick and drill down analysis. So we transaction level at the first level we get the overall picture, which actually helps in identifying the magnitude of the problem, magnitude of the given exception, and then we decide to go in deep or not. So certainly this is a time of a quick action, and leveraging the existing digital infrastructure is the key to succeed. That's from me.
Right. Thanks, Nilesh. Speaking of quick action, let me move over to Pankit. Pankit, what is your take on this subject? What are your views?
Josh, yes, digitization, use of existing tools, technologies for audits is very critical, especially in this COVID scenario where work from home is part and parcel of the new normal. Or going ahead, it will be like the digitized tools available with us, as well as new tools need to be explored to actually analyze and minimize the field work, especially going ahead, where a lot of analytics can be done around business. So especially for us, being in the cash management business, we have to deal in crores of rupees on daily basis, lot of transactions, and we are spread across India, more than 50 plus branches. So a lot of analytics which can be done before going to the branch on field if we are doing branch reviews, which helps us actually build the risk register and build the steps around the controls to be tested in a more realistic and pragmatic way. and it minimizes obviously the time spent at the branch or field, and also it helps us add value, like Rajiv correctly pointed, where in certain scenarios where we can go ahead and add value to the business by giving them suggestions or recommendations, and also helping them implement certain controls around it. So yeah, this digitization is the way ahead. So I think it's key to analyze data, use the tools to the optimum levels.
Right, right. Thanks, Pankaj. I think it was a good point that you made, that linking digitization to the risks registers and controls, I think, is important now. So Pradeep, what is your view on digitization? Should we use our existing digitization tools to the maximum advantage, or should we try and evolve, especially keeping in mind the current scenario, and I just, yeah, and one more thing, maybe we can just touch upon, say, budgets also, for that matter, because a lot of corporates are now taking a step back and reviewing or revisiting their budgets for the year. So it would be interesting to have your take and Rajiv's take as well on this aspect.
Yeah, are you able to hear me now? Yes.
Yes, I think it's pretty clear. Yeah.
Okay, thanks. So I think I think we have to be given the current scenario, deployment of additional budgets and extra resources, etc., will be a challenge, because most of the companies are going through business challenges. So I think the approach will need to be quite smart, in the sense that leverage the existing infrastructure and tools and technology within the company for the purpose of the audit function. So which is why I did mention that when we have started work in this space, we are trying to leverage our existing tools such as Power BI, etc., to create the right sort of analytics, and to use that as the means to take forward. The overall approach in the company is really split into two parts. One is what I call act now, which means what is required to get the business and the respective functions, including audit functions, to operate in the new normal. And B is what you call the plan now, which is what are the big changes which are going to happen in going forward, for which we will need to put the resources independent of how is the business going to be, because we are still very positive over India, and we believe things will turn around. It could take 3 months, 6 months, whatever, but things will come back to normal. So it should also not be a complete kind of complete standstill in terms of investments and resources. So we have created a certain set of actions on stepping up on digital. That platform and those set of actions impact business as well as functions, including audit, and we are going to invest behind the digital tools, but it is very, very carefully done, working through the kind of ROIs, prioritizing where the biggest bang for the buck will come. So those kind of work has been done. In fact, we have created almost 17 projects around this, and each of these are going through a fair bit of churn, and based on the kind of productivity, returns, etc., approvals are being taken and actioned. So I think it has been very smartly done. We can't say nothing we'll invest. At the same time, we can't be loose with our purse strings.
Right. Absolutely. I think very well, put, Pradeep. Rajiv, just very quickly, in the interest of time, is this another area of ADLI, or do you see a different kind of approach in as far as digitization is concerned? I think you're on mute, Rajiv. We're not able to hear you. Rajiv, are you able to?
Yeah. Okay. I think I was muted. I'm sorry.
Yes.
Sorry about that. So I said ADLI is there in every aspect of our life every day. Think about it.
Right.
Now, as far as the way I understood your question was that are you in the current situation? See, we always want, but we also have to give. Let's go with the concept, okay? We can't just want and not give. So my point is that today you want to reduce the internal audit fees, but you want the internal audit to do the same thing the way it was being done before. That's not fair. It has to be balanced. I feel what I would just like to speak what my belief is that today, because of the pressure on the revenue, the costs have to go down. At the same time, as far as the approach and deployment of the internal audit is concerned, that also has to be reprioritized. I think today, when the business in terms of the transaction volumes have gone down, I think the whole scope needs to be reprioritized. And again, I'm focusing on my pet subject, opportunity lost. In today's day and age, opportunity lost could be higher than the transaction that has already got clocked in. And therefore, the focus is to see when the pie is shrinking, is there a pie which is outside what you have done? Because revenue drivers are very, very critical at this stage. So how do you enhance your revenue drivers? Because there are no demand drivers. So how do you optimize your revenue drivers? Focus today has to be largely on revenue. Because if revenue comes in, costs, and you have already reduced your costs. Every company has reduced the cost. Focus has to be revenue, revenue, revenue.
Right.
And yes, because you're cutting down costs for everyone, whether you're doing pay cuts, you're reducing your AMC costs, you're reducing your salary, everything you're doing. So you have to focus on revenue. I don't know if you've answered.
Yes. Right. I think yes. I think you've answered the question. Right. So I think that brings us to the end of the discussion. Sachin, Murtaza, can we take some questions here for the panelists? How's it?
Yes. So I'll request Sachin to at least post couple of questions. I also recognize presence of Treasurer WRG C. Anand Jakotia. And
everyone.
So Sachin, if you can at least start with 2 or 3. And before Sachin reads out the questions, for the participants, just a small reminder that tomorrow Sunday, we'll be meeting 10 to 1. Our third day of the internal refresher tomorrow will be 10 to 1. And then 4th and 5th day will be again next Friday and Saturday, same evening 5 to 8. So Sachin, over to you.
Thank you. So we have one question both for CFOs and head of internal audit. In many companies, internal auditor head reports to CFO. There may be certain audit observations pertaining to corporate finance division, and the onus for the query comes on the CFO. This directly or indirectly may impact the essence of internal auditor's independence. So I think we should have views from CFO and head internal audit both.
Right. I think maybe we can ask Pradeep to sort of respond to this question.
Yeah, no, I think it's a very pertinent question, but I think we must understand the new world where there are multiple stakeholders and there are multiple groups who will need to be interacted with, and that is true for the internal audit function also. Remember that the internal audit function is also having a reporting into the audit committee. So in that sense, there is a bit of independence in that sense. Yeah, and whether the internal audit function reports into the CFO or not, that function will have to play a role. I don't see a problem in dual reporting. It's a bit like saying that as a finance function, there is a business reporting and there is a reporting into the board on compliance matters, and some of the issues that the finance function will pick up could be relating to the business and the CEO, but that doesn't mean that there is a problem in that kind of requirement.
Right. And I'll request Nilesh to pitch in here. Nilesh, what are your thoughts on this?
Generally, in nowadays modern models, this reporting to CFO model is not generally seen. It is always reporting to the audit committee chair and to the CEO administratively. So there are two scenarios here. Either the auditor or audit head reports to audit committee chair and a CFO. That was what Pradeep was explaining. And in this model, again, there is an independence because it is only the administrative reporting and our activities are mostly governed by the audit committee. But if there are some large companies privately held where audit committee may not be there and the reporting is only to CFO. In this model also, generally nowadays, all the top management people are anxious to know from the auditor which they really don't know, and they seek the help from the audit rather than pushing them to corners. See, finally, both the departments are internal audit and the finance or the CEO's function or the manufacturing or marketing, basically to add the value to the business and earn our targets of profits and shareholders value additions and all these things. We don't, if the internal auditor is bringing a relevant point and just because CFO is in a position to shut him down, who will be at a loss? Finally, the organization will be at a loss. No? So I to have at a person of a CFO level, Raju will is very consciously. So basically, it is not that internal audit point or I will show it as a my credit. That credit is not required for a CFO person because his contribution is much larger than picking up something from the internal audit and show it as his point. So with these expectations and the contributions, I think becomes the issue if it is handled in this particular manner. That's what I can.
Right.
My
Thanks. Thanks, Nilesh. Sachin, do we have time to squeeze in another question or how is it?
Yes, I think we can take.
We can take one more.
Yes, sure.
Yeah. So this question is to CFOs. In a COVID environment, do CFOs see internal auditor as a cost or an business or an enabler to achieve organizational objectives and process excellence?
Okay, could you repeat it once again, please? I think it wasn't clear.
Yeah, in a COVID environment, do CFOs see internal audit as a cost or an enabler to achieve organizational objectives and process excellence?
So okay, so thanks. I think there's only one person who can answer this, and that would be Rajiv, in my view. So Rajiv.
Okay, so my answer is going to be short and sweet. I'm sorry, I keep going back to my first or second answer. I defined that there were 3 internal auditors: an average internal auditor, a good internal auditor, and an excellent internal auditor. An average internal auditor who's basically just basically is a fact finder. That is a cost. But when an excellent internal auditor is never a cost, is always an asset, because an excellent internal auditor helps you to achieve the organizational objectives. So an excellent internal auditor is never a cost. It's an asset. But an average internal auditor is a cost, because that can be replaced with an AI. Sorry, can be replaced with an AI.
Right. I think Rajiv, thanks. I think you've summarized it in a very good manner. Right. I think Sachin, do we take any more questions or we're ready to conclude?
We can conclude. Murtaza, over to you.
Okay.
So we are extremely grateful to all the panelists and the moderator for sparing your valuable time. I now request Treasurer WRCC Anand Jakotia to carry out a well-deserved vote of thanks for the whole panel. Anand, over to you.
Yeah, thanks, dear Murtaza bhai. Respected and expert panelists, dear Suresh Dikite, Pradeep Menon ji, Ankit bhai, and Rajiv ji. Thanks a ton for your valuable inputs. Thanks for the fruitful discussion. You touched various latest and various important issues in the shortest possible. And dear listeners, thanks for moderating it. On behalf of WRC, we are really grateful for your give back to the fraternity, give back to the alma mater, and special thanks to all the team members who are working behind the screen, Subhash, Vaibhav, and WRC staff members. And second from the last, thanks to all the participants for effective participation. And last and special thanks to my colleague and dear friend Murtuza Bhai for all the efforts in organizing this series and organizing various webinars. In spite of this challenging time, we are seeing so many webinars happening, and the backbone is Murtuza Bhai, who is taking efforts since day one of this program. Thanks everyone. Over to Murtuza Bhai.
Thank you, Anand. Thank you, Judge, Pradeep ji, Rajiv, Nilesh, and Pankit. Excellent. I think very well. Good thoughts could come out from both the sides, from the finance side as well as from the Internet side. And I think how to, in the COVID time, change the plan, you brought out quite well. Thank you, guys. Thank you very much. And thanks to all the participants.
And
Thanks, Murtuza.
thanks to the co-panelists my side also. It's lovely.
Very
Lovely
much.
interacting.
Thank you. Thank
Very
you, my
well organized.
co-panelists. Wonderful session.
Thanks,
Thank you,
Nilesh.
everyone.
Thank you.
Thank you,
Thank you,
Mr.
everyone.
Pradeep. Thank you, Anand ji.
Thank you, everybody. Thank you.